Amazing. Good morning. Welcome back to Trade Live with IG. I'm Luke Moore. It is Tuesday, the 10th of December, and I'm joined by the one and only Mr. Richard McDonald.
Very good morning to you. I wish I was saying that I'd just come back from Paris, but apparently a little bit cold and rainy.
Worse than here, like way worse than here. 4 or 5 degrees all weekend, chucking it down in rain. No. It was not very pleasant.
Oh, but a great time all the same.
Oh, beautiful, beautiful. It was actually my first time in Paris, which is slightly embarrassing given I live and grew up in Kent, next to one of the Eurostar stops.
As it was built.
As it was being built, yes. It was my first time there. It was absolutely brilliant. Yeah, so just a weekend of food, good wine, good cheese. Went over to watch Harlequins, my dear Harlequins, play Racing 92. Unfortunately, they got beat, but that was the reason why we went over there.
Good.
It was brilliant, honestly, brilliant, yeah.
And wife has ticked the box for that bit of work?
Yes, yeah, so she was there to hand out the Man of the Match award, actually.
No way!
Yeah, so the bank she works for...
That's fantastic.
The bank she works for does work and with the European kind of Champions Cup, and so she was over there as a representative and had to hand out the Man of the Match award. So lastminute.com, we will run around the side of the pitch, like let in pitch side, so I'm standing there with the Owen Farrells, who wasn't playing, he was stood to one side, Henry Arundel, another English player, and then Danny Kerr and all the other Harlequins players, and there's just me and my wife just standing there like, this is good. And then she whizzed off.
You were just the wag.
Oh, I was the wag. Yeah. She whizzed off, shook a few hands, had a couple of pictures with Man of the Match was Nolan Garrick, the French number 9.
Okay.
So yeah, I've got a lot of competition, clearly.
Fantastic weekend.
Fantastic weekend, yes.
Sounds great. What you guys are chatty this morning. This is what we like to see. Dave G, good morning to you. Away from the numbers. Back on time this morning after sleeping in yesterday. Mark Carberry, very good to see you. Julian, Brian, Carl, Wolf. The whole gang is in this morning. It must be Takeover Tuesday.
Takeover Tuesday after Merger Monday. It is busy.
It is. We've got some great stuff to go through. So coming up on the show, what do we have for you today? Well, at 8:45, we've got Angeline with Tom's Takeover. And then after that, at 9:05, we've got Monty dialing in from the Middle East with the latest on client sentiment.
Lovely, nice.
But shall we go into some overnight action?
Let's get into it.
Right. Well, what do you think the top story is? Because there's about 20 sort of medium stories.
Yeah. Well, looking at the chat, I think everybody's getting quite excited about the Google chip, the Willow chip. That seems to be, what kind of is the main story out there in the tech space, which we know is driving all the momentum at the moment. They've just announced their new quantum chip Willow, which, look, I don't claim to be a chip expert, but when you start hearing stories about this chip is solving problems that would have taken 25 years and it's getting it done in 5 minutes, that sounds like a big deal to me.
Exactly, and put that together with what we've heard from Jensen in the past about what he can do for the medical sector, for obviously anything really that has large amounts of data that needs crunched, right?
Yeah, completely. Well, what were we talking about a few weeks ago when we were looking at the next year ahead? It was non-tech compounders. Was that phrase was it Goldman's used, or?
It was Goldman's piece of the year.
That was it. So non-tech compounders. So it's going to be, now that we've got AI as a process, how do you apply it? And I think that's where the next year's real winners stand for. And maybe this chip is going to be one of those things that really sets us off on our way. But if you look at healthcare, if you look at, healthcare is probably too big a sector. You look at drug trials. You look at the way that we can automate lots of processes now. The opportunities really are endless, without sounding too kind of dramatic about it. And maybe this chip is what you need, because it feels like there's a bit of a race to... Well, a race to produce.
A race to catch up.
A race to catch up. Did you see, I was listening to the FT's podcast this morning, and they were talking about the Japanese industrial policy that they've been kind of working on over the past couple of years.
No, I haven't seen that one.
Well, they're working to bring their chip production onshore. So they, and I wasn't aware of this, used to be the big players in the chip market back in the kind of 80s and 90s when it was becoming its nascent industry that it is, and it's now huge. They want that back. And so they're not afraid to bring international players in,
Okay.
but they want to be building factories in Japan, hiring local or kind of creating local champions, getting finance from government. So IBM are a big contract winner over there. And this just becomes part of this arms race, because you know that they're doing that in the States, the CHIPS Act, you know that TSMC is setting up over there. So it all comes down to who is going to be able to localize this technology.
In size, in bulk.
Completely, yeah.
And as you say, the arms race, we saw, of course, China's investigation into NVIDIA yesterday, into an Israeli company that they bought. I think it was back in 2019.
Was that Rayonics or something like that?
I don't remember the exact name, but it was. I mean, it was a $9 billion deal or something. It was tiny, but there's just this tit for tat going on just now.
Yeah.
At the moment, isn't there? A quick look at Alphabet there, just as we're speaking about Google, and really it's underperformance, right? So we started the year at $140, and we're up at 170 now. It just hasn't had a great year relative to others, has it?
Well, I suppose it's relative to others, is your point there.
Yeah. So 25% still a decent number, isn't it?
Yeah. Well, that's roughly in line with the market, right? 25%. What's the S&P at the moment? I think it's roughly up about that much. It's definitely lagged the rest of the kind of Mag 7. It definitely would do. So maybe this is something that's going to give it a boot in the right direction.
Good. Now, we said it. Takeover Tuesday, we've christened it.
Takeover Tuesday, yeah. So how long have you got? I could count about 5 or 6 deals announced in the last 24 hours, which is pretty significant.
Also a mid-sized chunk, isn't it? There's not a
mega one, but it's. I'm in a way I'm not surprised. You think about the last couple of years and the way that business has been done. There's been so much money poured into private equity, and a lot of these funds now need to exit their 2, 3, 4 year incubation cycle. And there hasn't been a good market for IPOs. No. There hasn't been a good market for raising debt to kind of list these companies on their own and let them stand on their own 2 feet because of the rate cycle. Post-Trump, now we're seeing rates come down. It feels like the M&A sector is starting to get a bit of momentum. So let's look at...
That's almost perfectly takes us into the front page of today's Financial Times as well. Yeah. Wall Street's complex debt bonanza hits the fastest pace since 2007. So this is talking about banks selling bonds backed by the revenues, and it says three categories there, and then Merger Monday spree signal revival of deals there as well.
So Merger Monday, where do we start? So probably the biggest one I think is Mondelez. Mondelez own Cadbury's,
and now
they're looking for Hershey's. Have you ever had any Hershey's chocolate?
I have such a strong dislike for Hershey. So I went to university in the States for 6 months, and we had, no ability to get Cadbury's chocolate and proper chocolate. So I had to settle for this Hershey's soap powder.
Oh, it's weird. Oh, it tastes like it's there's like a vomit kind of fakeness to it.
Yeah.
It's awful. But they sell a ton of chocolate, right? They're probably one of the biggest confectioners over in the States. Mondelez are listed in France. Is Mondelez a private company? Actually. I don't know, but they own Cadbury, so they're exploring options for Hershey's. Whilst you find that, the one that we've seen just this morning is the Prudential.
Yes.
Which is interesting.
I managed to pick up some yesterday as well, so I'm hoping that gets taken favourably.
So Prudential have got businesses all over the world, one of which is a Singaporean asset manager called East Spring. Now, they've said that they are looking at options to dispose of it. So they're trying to value East Spring at $3 billion. They are either looking to simply get rid of it. They are also looking at an option that could include selling about 30% of the company and forming a JV with somebody else. I think they're looking at diversification, so things like private credit. They're looking at asset management business, kind of everything that goes with that. Look, the asset management space is an interesting one, I think. Right? they've got rising costs. They're not immune to that. Staff costs, and these guys tend to be very staff heavy because they are in the relationship management space more often than not, and pressure from fees. So we all know there's a race to the bottom in terms of fees.
Across the board, yeah.
Across the board. So everyone's margins are getting squeezed. So I think that this is just something they're just looking to say, right, we want to exit. We don't want any piece of it. But it is interesting because to roll on with these stories, Vanguard just completely restructured its asset management unit. So they've got something like 900 billion in its asset management division.
Okay.
And I think what they're doing is Vanguard are known for their super low cost funds.
Yeah.
ETFs, passively managed, their platform's incredibly low cost.
You hardly even notice, right?
You hardly even notice. Asset management, they're trying to use that as a bit of a way to create some proper money, maybe stepping into that wealth space. So if they can do what, to wealth management what they did to fund management, that's going to be really interesting. So there are, you've got Prudential doing this, you've got Vanguard doing that. There are just a few things going on in that asset management.
You said it's valued at 3 billion.
East Spring,
Yeah.
which is the Prudential spin-off that they're looking to spin off. It's $3 billion.
So let's just take a look at the graph of the Pru there and see that, how it's come down, starting the year at 886, now trading £2 lower. The market cap puts that on just over 18 billion sterling. And we're talking about this asset manager being worth around about 3. Yeah, so, a sixth of the company.
That's quite significant, actually.
It is. It's more significant when you realise how small UK companies are relative to what we normally talk about in the US, right? So, okay, good.
Should we roll on with some more? Because there are a few more.
Let's bring them on.
Just before we get into stuff else that we've released this morning. So Omnicom, there's an advertising business. They are bidding for a company, one of its rivals, into public. And that's an all-stock deal, so potentially playing on the idea that shares are at highs, and so they're issuing stock to pay for those ones.
Yeah.
I want to just get through a few more other. Gallagher, who are a UK-based insurance business, they have bought assets from a private equity firm, Assured Partners. I only know that because Gallagher sponsor the Premiership Rugby. So
I did think that's...
it always rings when I'm listening to the rugby at the weekend. So Gallagher have bought some assets. We've then got
There's the story there, if we just want to hit that one on the...
There's Gallagher as well on the FT.
Yeah.
Yes, this was...
13.5 billion.
So there you go. Look, US companies have forged more than $35 billion in deals on Monday. So that just goes to show where we are. The other one I just want to mention there was Apollo, big private equity company. They have bought a company, Novolex, for $18 per share in cash, which is at a premium to where they were trading at. No, excuse me, I've got that wrong. Apollo-owned business, Novolex, have bought a company called Pactiv Evergreen, packaging business, but they paid a third higher than the stock was trading at.
Right.
So there's a lot going on.
So a lot going on there, but we also had confirmation yesterday that Canal Plus is to list in London after this Vivendi breakup was confirmed yesterday. So here's a story we've got in the Times there. There's Paddington. On his way back to London. And we...
marmalade sandwiches?
Not at all.
No?
Oh, keep them away.
Oh, I had the best crêpe Suzette at the weekend with a bit of marmalade on it, some Grand Marnier. Oh, beautiful.
They know how to do breakfast.
They do. It was slightly later than that, maybe. It was in the morning, but
I mean, of all the things you could,
on the wrong side of my sleep,
get with brie or a nice croissant or something. Producer Fred brought an apricot bar through to me this morning.
An apricot bar?
Yeah. I was starving. I said I didn't make it to Greg's. There was too long a queue this morning. Wanted to rush in. And he said, oh, don't worry, I have breakfast for you.
An apricot bar. Thanks, Fred.
Apricot bar.
Thanks, Fred.
Fresh croissants. Come on.
Where are we? Yeah, so looking at Vivendi.
Yeah.
Interesting that they've
when is this due to come? Do we have a date for it yet? Is it before we get Shein, the Chinese business? I don't know that it has, but I just want to riff on something. Andrew McKelvey, I spotted in the chat talking about Ashted's results this morning. Yes, Ashted's.
So when we'll start to think about all the kind of pre-bell stuff. But the most pertinent point is they actually are thinking about moving its primary listing away from London.
Is it still just thinking? Yeah, or
It's consulting on it.
right?
Yeah.
Right.
So, vote of confidence from Shein and Canal Plus. Ashtead on one hand it giveth, and the other it taketh away.
But it does have quite a large component of its business in the US, doesn't it? I think Ashtead. So, there we go. That's 2 years. So the year chart, we're looking up from 55 to 62. So about 13-14% there on the year.
Yeah, well, let's just take a quick look at what they've announced this morning. So they are consulting on moving its primary listing away to the US. It was kind of a footnote to the RNS.
Oh, it's part of a profit warning, right?
It is also part, I wouldn't say necessarily a profit warning, but certainly downgrading its forecasts a little bit. So where are we seeing? So it's rental, there you go, you've got it there. So I saw that its rental revenue expectations for the year have been downgraded between 5% and 8%, down to 3% to 5%. So they've lowered their expectations a little bit. But that is announced alongside a lift in their interim dividend per share and an increase in a buyback program. So it's probably the weight of which money, how much is that offset of rental revenue going to be changed by this announcement of the buyback program?
Yeah, it's going to be an interesting one to watch on the open, actually. Not one that I've traded before, I must say. Well, not for a while. I've traded it part of a basket maybe 10 years ago or something.
We've got some early calls from one of our market maker friends calling it down for 5%.
Okay.
So one to watch on the open.
Yeah, it could be interesting. Could be an opportunity there.
Might be one to watch. Elsewhere in the UK, we've also seen news, a retail favourite of our clients, Boohoo. I know they've been in the news a lot recently. Mike Ashley, the retail behemoth that he is, just swallowing up everything that seems to sell anything to consumers. They have voted, or they're trying to convince their shareholders to vote against Mike Ashley in the upcoming general meeting, saying that they want to vote against all resolutions, or they think shareholders should vote against all resolutions, stating that he lacks specific plans for change, as you can see on the screens there.
Great, right. Now some quick upgrades and downgrades. We've got quite a few in the UK this morning. We've got Goldman's upgrading British Land to buy with a £5 price target. We've got Barclays downgrading British Telecom, BT, to equal weight with a 190 price target. JP Morgan downgrades Schroders to a £3.53 target. The JP Morgan go to overweight on Unite for those students, £10.70 target. And the Daily Telegraph pushing Heidelberg Materials. That's where I had my first date with the German.
Oh, they're cementing
in Heidelberg. We cemented our love there.
God.
Oh dear.
High quality chat this time in the morning.
So Heidelberg Cement, Heidelberg Materials, the Daily Telegraph's pushing that. And then also in the Times, there was a comment section, I think it was Laura Almeida pushing Tesco, saying that Tesco has more to run, even after 25% up this year, I think it was. So, interesting one there. Just quick news stories there. BP shunts offshore wind business into a joint venture. So that's seen as a retreat by BP from renewables.
And where are those? Is it giving an indication as to where that is? That's UK, right?
That's right. Yes. So it's the where we go.
So they're moving it on with a joint venture with the Japanese power company there, JERA. That's interesting because UK Power was supposed to, I suppose, have a handle on this. I know that they're not issuing any new licenses for oil majors or miners in the North Sea, but you would expect that wind farms would be a focus of the new Labour government's push.
Exactly, yeah. It's an interesting one because, of course, then you've got SSE building Dogger 2 at the moment as well, of Yorkshire. So it's did you took the Eurostar to Paris?
I did take the Eurostar, yeah.
Because flying back over the channel, it is absolutely incredible to see these things at work.
Really?
It's insane. The amount, as you come, I guess it would be more from Belgium
Coming over, or kind of Amsterdam, that kind of down that side.
Yeah. There are hundreds of them, and they're huge. And yeah, just great to see.
I can only imagine if you listen to Donald Trump that there were lots of confused whales or birds just left scattered around the place, because that
Exactly,
must be what happens.
Yeah, yeah. And the French fishermen as well. Right, and then, one more quick story there. Signs of insider trading detected in a third of UK takeover bids. You could actually see last week, what was the stock that was? Direct Line. Mm-hmm. The bid came at something like, or the bid came on the Wednesday, and on the Tuesday morning at 8 a.m, the stock was up 7% for no reason.
But it came a couple of times though, so the Aviva...
No, this was before before the very first time it came out. Then there was a spurious move up 7%.
See, stuff like that doesn't help the UK at all.
No.
Is that a third, did you say?
So a third of takeover bids have signs of insider dealing detected in them.
Wow, that is shocking. It really is. But things like that do not help our case here in the UK.
No.
Because if you were a Shein, or if you are I imagine a Mike Ashley, okay, very active in that M&A space, if you see things like that, it's going to lose your strategic edge. Well, first and foremost, because these deals are quite leaky.
Yeah.
Or a third of the deals are quite leaky, and it just erodes any sense of, what's the word I'm looking for? Not legitimacy.
Credibility.
Credibility.
Yeah.
Credibility. Yeah. That's shocking.
Right, then over on Yahoo Finance, we've got some headlines there. Of course, the China move dropped again, really, after some terrible trade figures across there. So it was a real slow in export growth. Import dropped the most in, I think it was 12 months. Mm-hmm. So we had a drop back in the Chinese market after beginning the day up 3%. Mm-hmm. Look at the all sessions yesterday. JD.com up 11.5, Baidu up 8.5, Alibaba up 8. Real huge moves.
Neo, top of the pops.
Yeah, Neo. And then we didn't cover Oracle. So Oracle, poor numbers after hours. So that looks like it's going to be weak first thing this morning, down 8% in the after hours.
AMD there, taking some of that heat off of NVIDIA, I suppose.
Yeah, so NVIDIA, was it 2.5% NVIDIA was down?
Yeah.
Should be there somewhere, yeah, 3%. Yeah. So, but a quick look at China as well. We just see how it sold off relative to its jump yesterday. So there you can see where that's the daily, wrong chart. Go on the 10 minutes.
Oh, look at that.
There was the news.
Thanks for playing, guys.
Came out live as we went on air yesterday.
I saw your TikTok. A bazooka.
I don't think it's the bazooka yet, but they've taken the bazooka out of the storage
and they're
just lining it up. Yeah. Yeah. So there is a central economic work forum to take place at the end of this week. So that's when they think we might hear more. But those trade figures, you can tell exactly when they came out, right at 1 a.m. And you can see the sell-off in China. So it hasn't been able to hold it, unfortunately.
That's a real... When I look at that as a broker and as a kind of sales trader, it's a real thanks for playing the game kind of move, that is, isn't it?
Yeah.
Because you've got loads of people that have been sucked in on the way up. Mm-hmm. There's exit liquidity for people that have been in, and then the trade figures come out and it's tanks all the way back down again.
Yeah. And it just shows you
if you're FOMOing into a move because you think, right, this is it, this is the move, you have to use risk management. You cannot you cannot trade a move like that without using stops. You just can't. It's impossible.
Yeah, but it'll be interesting to see on the open because copper is still higher than where it was before the news yesterday, 424.5. We've got iron ore popped up above the 800 level.
Yeah.
So there is some strength there still, but the FTSE looking down 50 basis points. Germany down 30, France down 40, and we've after a weak session in the US, we see S&P unch and Nasdaq
unch. Let's keep an eye on the miners then as a result of that.
Yeah,
Keep an
definitely.
eye on the BHPs, the Rios, the Anglos, those guys, Anglo-American, because they are all going to be active then today.
Good. And then we've got Prudential as well to keep an eye on as well. So we're going to have a quick break, quick 3 minutes, and we'll be back with you for the Open.
Rise and shine with IG's new morning show, Trade Live with IG, covering all our UK product offerings, including our OTC and exciting new US listed products. Starting in September, join us every weekday from 7:30 to 10 a.m. for exclusive insights from our trade desk, expert trading concepts curated by our friends at tastylive, global guest appearances, and loads of viewer interaction. Regular platform feature highlights and up-to-the-minute market updates. From casual chit-chat to in-depth analysis, we've got your morning covered, live on IG.com, YouTube, and in IG's trading platform. Whether you're a seasoned professional or just starting out, there's something for everyone. Tune in, stay informed, and kickstart your trading day live with IG.
Fundamental analysis is a method of evaluating assets to assess what their prices should be. It's based on the principle that every asset has a real fair value, which may be very different to its current price. It assumes that markets will naturally correct to reflect these fair values over time. The aim is to discover assets that are currently underpriced or overpriced, then place trades to profit from the expected correction if it materializes. Now, unlike a technical analysis that focuses on price charts, a detailed fundamental analysis would look at everything that could drive future price movements. The technique is most commonly used to scrutinize the price of shares, where annual reports, industry trends, and a company's management team may form part of an overall assessment. However, fundamental analysis can be used to review the price of an asset. A commodity like oil, for example, could be evaluated on the basis of economic data, regulation, brand recognition, geopolitical factors, and technical specification, among other factors. But while fundamental analysis is often said to be more comprehensive than technical analysis, it may not give you the full picture. For one thing, it's generally only useful for identifying long-term trends, whereas a technical analysis can help find short-term opportunities. For this reason, it's often a good idea to combine elements of both types to get the most accurate view of a market's direction. To learn more about fundamental analysis, join IG Academy today. It's completely free and gives you access to dozens of trading topics.
Welcome back. It is the opening bell, and we've got quite a lot to keep an eye on this morning, haven't we?
We do. Do we have any moves to see how things are looking?
So we have the UK auction has just opened up, so we are waiting for the market to open. Ashtead, it was initially called down 5% by the market makers. The auction is indicating down to be 5.2%.
Oh, that wasn't a bad guess by them then.
Hang on. And let's have a look.
BT down 1% on that downgrade. Centrica down 2%, seeing full year 24 EPS broadly in line.
Prudential indicating down 2%.
Oh, really?
Indicating down 2% so far this morning.
I guess that's on the China move rather than the asset manager.
Yeah. And what else are we looking at? Because I can get the auction prices here. BT are indicating down 1%. What were they called by the market?
Down 1%, yeah. Rios?
Rios.
They call her Rio.
My name is Rio. Flat, down 0.1%.
Okay, we'll take that.
What else have we got? Anglo-American on this iron ore move, down 0.5%. Down, I was expecting that to be probably up.
Louis Vuitton.
LVMH, they've got some lovely shops in Paris. Some beautiful shops. They're down 0.8%.
Did Mrs. Moore pop in there?
She did.
Oh, really?
Yeah, she made a purchase as well. She did.
Oh, wow, excellent.
Yeah. She saved a bonus that she got in the summer, so she's looked after herself.
Right, you got 10 seconds to ring the bell on your
Do it.
your purchase on Louis Vuitton. 3 seconds to go till we get the opening move on this Takeover Tuesday. There we go. Wonderful. Right, we are off and running straight away with some early moves. John Wood looking down 2.7%. It's a wide spread there. Burberry down 1.5%, giving up some of the games from yesterday on that move down from China. L'Oreal also down 1%. Air France, the losers.
Ashtead
of
not
the morning.
out of its auction yet.
Right, so that'll be another 5 minutes there then. British Land on the upgrade, up 1.2.
Prudential has opened down 1%, trading 672. So a muted reaction there. Ashtead indicating now down 7.5%. Not out of auction just yet.
Oh dear, oh dear, oh
That is a
dear.
biggie. That is a biggie.
Tesco's is one that I think I would sell some upside call options in. So I'm going to have a look at that later.
So they're up a third, 366, a third of 1%, that is. What else do we have? Anglo-Americans scuttling around the bottom of the FTSE 100 so far, down 2% alongside BT.
Boohoo showing up 6%.
Boohoo.
0.6%. Producer Fred's shouting things in my ear about Boohoo. I thought it was something exciting.
Boohoo up now 1%, 35.44 they are trading. And Fraser's Group up 1%. So seemingly the market likes that from both parties, actually, I would say.
Good, good, good. Right, Trainline, yeah, British Land, Marks and Spencer's. Not really any big moves, to be honest, is there? There's
No, what are we looking at over in Europe?
BT down 3% on that downgrade. It seems a bit harsh. I never understand these, right? So Barclays have downgraded, but they've got a 190 price target. So there's still 25% upside in BT on their figures, and it's down 3.5%.
Well, I'll tell you what,
It's ridiculous.
why don't we take a look at the tip ranks and see what else we can see on BT? Where are everybody else positioned?
Right, so here, no tip ranks dates for this.
I know
market.
that
That's
we've had
strange,
some mapping problems just with codes and whatnot. So perhaps that's one that we need to flag over to the IT
7
guys.
times PE, 15 billion market cap, 5.2% dividend yield. Yeah, let's see if that one. It just annoys me that the algorithm, because that's an algorithm, right? There's no way that a human is selling a stock down 3.5% on a downgrade with 25% upside.
Yeah.
It's just these things.
Yeah.
These computers and algorithms,
Bloody
damn them.
British Land, what have we not spotted there? They're flying.
Yeah, no, that's the upgrade. So
they've got upgraded.
Goldman's upgrade to £5 price target. So there's some big price targets coming at this time of year, isn't there? JP Morgan and IAG last week, £5 price target, and the stock's at 260 odd. And British Land. Producer Fred now shouting, have a look at Moonpig in my ear. Moonpig.
So just before I came on the show, I'm rifling through all of the different news releases this morning.
Yeah.
Centrica, Boohoo. So Centrica we haven't covered. I need to just have it. I saw it up on there, so we'll take a look at that in just a second. Ashtead, Moonpig got a headline, and then I just moved on because
it's Moonpig.
I asked Emma, who was looking through all of our client positions this morning, is anyone in Moonpig? Does anybody care? And
Yeah.
she said no. So I didn't look. I moved on.
I think it's really useful because I do get a reminder from them when it's my sister's birthday. Otherwise, there's potential that I would forget. So, I'm a believer. But, yeah, I've never heard Moonpig in French before. That's quite a shout.
Look at Centrica. So we didn't cover this on the opening bell or before the opening bell. They had announced their quarterly update. So they've said they saw their earnings bang in line. So we didn't cover it because it was all fairly dry stuff. Fair strategic progress. But what they've done is they've got a fairly beefy share buyback going on at the moment. Well, I know you like your share buybacks.
Yeah.
So they've announced
300 million, was it?
300 million was an extension
Okay.
to its programme. They've already bought back £1.5 billion worth of shares since November 2022.
Yeah.
Pop quiz, what percentage of the company do you think that is worth?
So that they're doing now, or that they've bought back since?
So they've done 1.5,
Yeah.
and now they're going to do another 300 million.
Okay.
So they're increasing it by what?
But that 1.8 billion, how much of as a percentage is that of the company?
No, of the 1.5. Sorry, 1.5. How much of that represents what the company is?
12%.
20.
Yeah,
They bought back 20%. They bought back 20%. Look at how's the pricing on it?
That's just incredible. They're
Yeah, so they've been since 2022 buying back their stock. So where does that
okay,
take
right.
us
So
back
over,
to?
yeah.
Right, so they've been paying higher prices, ish.
Yeah.
Buybacks are
It's such a tricky company, isn't it, Centrica? I mean, it had its great year back in. Well, we're not going to be able to see that, are we? If that's.
So Centrica, the British gas owners, aren't
Yeah, look at that. I mean, that incredible year in 20. Well, from the start of that buyback, really.
Yeah, but don't forget
that was probably here.
A lot of this was driven by external factors. You know,
Mm-hmm.
high commodity prices. They were able to defend their margins. They did fantastically well out of it. Did they ever get a windfall tax like the oil companies did? Because gas was priced at a premium for a significant amount of time, as we all know, which drove inflation, which drove higher bills for everybody.
Okay, right. Let's get an update here on some of these moves then. So BT bouncing there, down 3.6 was just absolutely ridiculous. Why I didn't buy some of that, I've got no idea. Hopefully, right, Kering down 1.5, LVMH down 1.3. So those are just giving back some of the decent gains yesterday.
Is that some of the? Oh, I imagine that would have been some of the China gains, some of the Chinese gains. Kering, LVMH, because you've also got Hermes there. You've also got less so the car manufacturers. But yeah, certainly, I'd imagine that was tied to the China semi-bazooka being unsheathed as you said yesterday.
Yeah. Oh, I'm still a believer in the bazooka. You know, the trade numbers are just. We know the reason for the bad trade numbers. It's because there's a trade war coming up.
Yeah.
So everybody's pre-positioning their.
Can I jump in?
Yeah.
Takeover Tuesday continues momentum. Fresh headlines. There is a private business called Resolution Life Group Holdings, another insurance company. I believe that's listed. Resolution Life Group Holdings. Fred, if you can let us know where that is, either a public or a private company. Resolution Life Group Holdings. Nippon Life Insurance to buy Resolution Life for $8.2 billion, just reported in the Nikkei.
Oh, that's quite big, right?
That is quite big. Resolution Life? Not a stock I've heard of. No.
Resolution Minerals, no.
No, perhaps it's a private company. But Nippon Life, Japanese stock, we know that, with the ticker 0001, according to the email that I've just got.
That was Nippon, was it?
Yeah.
Very good. Right, the winners on the day then. British Land up 1.4. St James's Place up 80 basis points. Further reorg. I actually wanted to have a look at St James's Place yesterday because there was so much bad feeling about this one, obviously. And is it actually turning itself around? As a client, then I'm particularly interested because, you know, I'd like to know where my fees go. But we'll see it there. That's the 2-year chart on the daily. And you saw it drop in April there as those stories came out. But the recovery, it's up 100% since then.
Well, I saw a headline. I was reminded that I was on the show this morning as I was on the Eurostar coming home. So I was furiously trying to check on the news and bring myself back up to speed after a few days out of the loop. And I think it was either the FT or the Telegraph ran a piece. It must have been. I think it was the Telegraph saying that they've had to cancel a lot of their glitzy Christmas parties and entertainment. They used to do huge parties, and the new CEO, whoever's gone in there to restructure. No more fun.
Yeah, and
guys.
client dues and all the kind of the good fun stuff.
Yeah.
But yeah, it's certainly the turnaround is being seen in the share price now higher When did this story first break? I wonder. Was it as far back as July 23? That looks like the kind of the breaking of the story, doesn't it? But what's St James's Place going to look like in the future?
Did they get hit a long while ago by who was your man, the big UK fund manager? Hargreaves Lansdown Limited with
Neil
Woodford. I think they had a decent amount of exposure to him.
Yeah.
So that would have really hampered their performance for a little while.
Wow. Yeah, you can see. Wow, it was a real fall from grace, wasn't it? This stock used to trade at £16.
Yeah.
Oof, down 70% at one point. That was over a couple of years.
Do they yield well?
Let's have a look at the old fundamentals there. 1.6%.
Terribly.
Yeah.
Well, not terribly, but that's not.
That's an average yield in the US.
In the US, it is for a growth company.
Yeah.
Not for a heavy, costly restructuring wealth manager, unfortunately. But another interesting play in this kind of wealth management, asset management space. Does a Vanguard, who we know are restructuring their asset management business, come along and take a look at a company like that? We don't know. It's Takeover Tuesday. Anything could happen.
Yeah.
It just feels like, we know that
I think if somebody was going to do it, they would have done it at its worst point. It was very vulnerable then, wasn't it? But right. Other moves then. For Expo down 6%. We've got the miners now starting to give up some of those gains from yesterday. Down 2 in both Anglo's, Glencore and BHP. Ashtead off and running. Let's get that one up. As you can see, I don't trade it, so it's not even on my radar there, but down 7.5.
How are Stellantis trading? Just seen a headline. Stellantis are the European car manufacturer. Peugeot, Fiat.
Fiat, yeah.
They've just announced
all the terrible cars.
All the terrible cars. They've just announced, as of 2 minutes past the open, so 10 minutes ago, they're to invest up to 4.1. I've got my glasses on. 4.1 billion euros in an EU battery venture with CAT-L, which is a Chinese manufacturer.
Okay.
That's interesting because we know through over the last couple of weeks, Northvolt was the big European champion of batteries. They've blown up, basically. They raised so much money. They were one of the most successful private firms in terms of raising capital over the last 5 or 6 years. Terribly mismanaged, completely blown up, filed for bankruptcy. All of the big asset managers that had exposure have written down their exposure to near on zero. Now you see Stellantis partnering with a Chinese firm for a 4.1 billion euro battery venture. So clearly making the decision that batteries are not to be manufactured in Europe by a European champion.
Yeah.
We're going to go and partner with someone that knows what they're doing.
Yeah. That can run the business properly. Right, shall we take a quick look at my portfolio look more? So we put this on yesterday. I did add to it as well, but we can, no, Moonpig is not in there, producer Fred. Not yet. So we the short France is certainly working, short French producers as well, and then the short DAX and the hedge of the S&P 500 is working. But what has turned around this morning is my Rio Tinto that was making good money yesterday. We can see that has turned around and is now flat. Glencore now flat. And the German auto still making a little bit, but I must admit I like this portfolio. I like the way it acted yesterday. I still think we've got news to come in China over the coming weeks. It's very much a catch-up portfolio, right? Because you've got long luxury goods in Louis Vuitton. You've got long German autos, long mining stocks, the underperformers, long Prudential. Standard Chartered is the one that's been a big performer. So if I was going to cut something, I'll cut that. And I'm happy to take that one off. Yeah, because that's been a huge performer, right? The rest are underperformers. Into the end of the year, there is a chance that you know, what we used to call buying the crap. right? But this is certainly not these stocks. That's not a representation there. But the underperformers of the year just have the chance to go from being real underperformers to not quite as bad. And there's a chance that we see a bit of money come out the S&P, a bit of money come out of the real winners.
Well, I saw your FTSE long there with the short put and the long the underlying.
Yeah.
So that, I imagine that's been performing fairly well over the last week or so.
So that was
put it on.
Most of this was just on yesterday, and it was a long UK, short Germany, because we'd already seen Germany break out, and I just don't think that that's deserved, because the German economy at the moment is in a shambles.
You sold the top there. That's a fantastically timed short. Look at that. Look at that.
Oh, I must admit, that's on the daily. Let's have a look at more of the 10 minutes. Oh no, almost.
Not bad, not
Almost.
far off.
And that was thanks to Chris Beecham, actually. We had a great chat yesterday morning.
Nice.
And Chris, in his ever eloquent ways, it felt like having a fund manager
Coach you
or
through.
a research analyst next to me. Back in the days of hedge fund world, when you're just sitting there and your research analyst sitting on the desk opposite you, and you're chatting about things on the open, and the China news had just broke.
Oh, perfect.
And it's so unfortunate they've given up those gains this morning. So that's the big question now.
I'm just sorry that I'm not quite at the caliber of a fund manager researcher. Sorry about that.
I mean, you're covering Moonpig.
Oh yeah, great.
I mean, we've got Moonpig and Resolution.
What do we think the market
And
cap?
Mondelez.
What do we think the market cap of Moonpig is? Let's have a look. Market cap.
About 800 million, my guess.
800 million, your guess. Okay, let's go. That is rapturous laughter from the from backstage. It is
100 million?
Buy that 920.
920, and that's
920.
but that's yesterday's number because it's down 11% today.
That is going to be correct. Yeah.
And it's almost as if I've got an earpiece with them telling me the answer.
Unbelievable. There's me. I haven't got any earpieces, by the way. This is me, my laptop.
We're going to invest in you for next year, Luke Moore. Don't you worry. By January, you will have an earpiece.
Oh, clearly. I hope so. I can't wait to graduate.
Now, what's the...
Did Ashtead come out of its auction? Sorry, we missed that. Down 8%.
Ashtead down 8, that's right.
Ashtead, we saw that open late. Trading 57.76, down 8%.
Down 8%, that's tough, isn't it? But so that profit warning was a move from a range of between 5 and 7 to 3 to 5.
5 to 8 to 3 to 5. Yeah,
and that was percentage growth.
Yeah, but I mean, there's some decent numbers in there. They're a big share buyback, 1.5 billion over 18 months. Again, let's play the market cap game on that. What does that equate to in terms of a company? I'd imagine smaller than Moonpig. Ashtead market.
Let's hope it's bigger than Moonpig.
25.2. So you're buying back, not even 5% of the company. So I can imagine, it's not as big as they probably would have wanted.
But what we're not getting there. What I'd like to know is the PE ratio, and then look at what discount it trades relative to its US counterpart, because that's where the real upside is.
So go on then.
Right.
Who do we know in the US that is a rental equipment business?
Well, so the one I used to play was the Scottish company. Back in the day, it was all the electrical. They used to power Africa.
Okay.
Because when there was problems or the mining companies needed extra, then this company, it started with an A, traded it.
Well, I tell you what, Google's come to my rescue. Ashtead being a industrial equipment rental company, that compares quite nicely with United Rentals Inc. And if you look at the market cap difference between the two, United Rentals is roughly...
Which is exactly what Andrew McKelvey just said on the chat. United Rentals.
Yeah, well done, Andrew. So it's twice the value of Ashtead. It's 54.8 billion. Yesterday's closing market cap for Ashtead was 25, so take 10% off of that. That's going to be 22 billion. Take 8%, more like 23 probably. The PE ratio, however, actually pretty comparable.
United Rentals up there at 22 times earnings.
22.
22 times earnings.
Ashtead are 20.8.
Okay.
So pretty comparable.
Yeah.
You're buying twice the company though, because you've got twice the size over there, of course, but you've got more earnings, which will be worth. Look, I think it's going to be one of those things that's worth keeping an eye on. How has Ashtead traded in comparison to that as a stock?
So there, yeah, on the 5 year, that's the PE ratio, right? So what do we want then? We want a year to date on the price chart.
So fairly solid. They're up. What is that? 495 plays.
Yeah.
835, so 30%.
Oh wow,
that's huge.
Yeah, nearly 40%. Right. So United Rentals up 40% on the year.
And Ashtead is 53 quid plays. Where are we now? 57?
Yeah, so up 10%.
Yeah. So not the same business.
If you're tuning in thinking, what are they talking about? We're trying to work out. Ashtead announcing this morning that they're considering listing in the US and leaving the UK. We're trying to look at the upsides. We're trying to look, is it a premium? Okay, because we know that pharmaceuticals, the energy companies always trade at a discount in the UK, as do many companies, defensives as well. But
so then follow that logic through then. You've got a company in United Rentals that is roughly the same PE, but twice the value. So therefore, Ashtead must be looking at that saying, our share price could be double what it is now, even if we maintain a similar earnings level. Is that how that would work? Or would it then go with the PE ratio half if earnings are consistent?
Yeah, more. I think it's more about being rewarded this year especially, and but yeah, we take a look into it and seeing if they think they're trading at, and that was a very rough guide on the PE ratios as well. So it might only be a 10% discount, but they think that they're the better company. Right, so yeah, we probably should go to a quick break now before we jump into some questions. Just a quick shout out to everybody on the chat. Thank you for your RC, that's a new one this morning. RC saying that the German 40 is looking like it could be vulnerable.
That'd be a good one to talk to Monty about when he comes on. Certainly.
Exactly, yes. Certainly. Let's see how the client sentiment is in that one. Wow, look at that. That is the daily going back 5 years there.
Yeah, look at that shooting stuff.
Excellent. Right, see you in 3 minutes.
See you in a bit.
Rise and shine with IG's new morning show, Trade Live with IG, covering all our UK product offerings, including our OTC and exciting new US listed products. Starting in September, join us every weekday from 7:30 to 10 a.m. for exclusive insights from our trade desk, expert trading concepts curated by our friends at tastylive, global guest appearances, and loads of viewer interaction. Regular platform feature highlights and up-to-the-minute market updates. From casual chit-chat to in-depth analysis, we've got your morning covered. Live on IG.com, YouTube, and in IG's trading platform. Whether you're a seasoned professional or just starting out, there's something for everyone. Tune in, stay informed, and kickstart your trading day live with IG.
Fundamental analysis is a method of evaluating assets to assess what their prices should be. It's based on the principle that every asset has a real fair value, which may be very different to its current price. It assumes that markets will naturally correct to reflect these fair values over time. The aim is to discover assets that are currently underpriced or overpriced, then place trades to profit from the expected correction if it materializes. Now, Unlike a technical analysis that focuses on price charts, a detailed fundamental analysis would look at everything that could drive future price movements. The technique is most commonly used to scrutinize the price of shares, where annual reports, industry trends, and a company's management team may form part of an overall assessment. However, fundamental analysis can be used to review the price of an asset. A commodity like oil, for example, could be evaluated on the basis of economic data, regulation, brand recognition, geopolitical factors, and technical specification, among other factors. But while fundamental analysis is often said to be more comprehensive than technical analysis, it may not give you the full picture. For one thing, it's generally only useful for identifying long-term trends, whereas a technical analysis can help find short-term opportunities. For this reason, it's often a good idea to combine elements of both types to get the most accurate view of a market's direction. To learn more about fundamental analysis, join IG Academy today. It's completely free and gives you access to dozens of trading topics.
Welcome back to Confirm and Send this morning, where I'm looking forward to actually the questions I think we're going to get. I haven't been in for a week or two. No, was I here last week? I think I was. So I need to rack my...
I'm pretty sure you were here.
I think I was here. I think I was here. So I'm here to rack my brain to see if I can answer your questions.
See if there's any taxing ones. Be sure to drop us some questions in the chat as well if you have any for Luke Moore this morning. Anything about the platform, anything about commissions,
products, yeah, anything that is on your mind, drop it in the chat and we'll see if we can take it down for you.
Excellent. Right, let's go to question 1 then.
During which specific period does the Santa Rally typically occur? Great question.
Excellent question.
Great question, because it's one that everybody seems to be asking us at the moment.
And it's thrown around so much as well, isn't it?
Oh, it really is. It really is. And actually, for those that have subscribed, it was on my podcast. Our podcast, as Pete Ward called it last week. Pete and Sean, I'm sorry, our podcast. We were talking all about...
It's you, Peter Ward, Sean Power.
Sean Power and me. The podcast is called Talking Shop. So whenever we see clients, we get to talk a little bit of shop, and what we really wanted to do was put you on as a fly on the wall on the trading floor. So this week it was all about the Santa Rally. Came out last Wednesday. You can find us on all major podcast places. And I think we tried to give the Santa Rally a bit of context. You know, what is it? There you go. That is... Oh, look, they've given us a nice little thumbnail now. That's nice.
Santa Rally secrets.
Santa Rally secrets. So, to give you the... did you ever get those things where you see a really long block of text and then someone does TLDR?
Yeah.
So, okay, it's the TLDR.
Here is the TLDR.
Too long, didn't read. Roughly the middle of the month is probably where I give you the analysis. And there's lots of reasons for it. So, IG did some analysis fairly recently where they looked at if you were to purchase either the FTSE or the S&P on the 1st of the month and sell it on the 31st, how much do you stand to make? And then do it on the 2nd of the month and sell it 3rd of the month, sell it 4th, etc., etc., etc. And they found that if you were looking at the FTSE, the 16th of December, looking back over the last, I think it was 38 years now, if you were to buy the FTSE on the, going back 38 years, if you were to have bought the FTSE on the 16th of the month, you'd have made roughly 1.7 times your money by the end of the month.
Add to calendar, 16th of December, buy FTSE.
When have we got? Actually, is the 16th even a weekday this year? It is, next Monday.
Great.
There you go. The 15th would have given you 1.69, so 15th, 16th.
Okay.
Sunday's the 15th.
Well, now you've told everybody it's going to go up on the 15th, isn't it? So we better go a day early.
Exactly, we better go a day early. The S&P, similar, but you'd be surprised to know not as much. 16th of December would have returned you 1.28% on average.
Okay.
Your phone needs to stop talking to you now.
She's just confirming.
Confirming and sending. So there's a lot of reasons for this. You typically see a bit of a move higher at the start of December, a dip into the middle of the month, we found. And then as people tend to, where do you spend your Christmas? Are you down here in London, or do you go see family?
I was meant to be, but I'm actually going back up to Scotland now. So, jumping on the train after the show on the 24th. So we do have a show on the 24th, and then I'll be racing off to St Pancras and up on the, not quite driving home for Christmas, as Chris Rea once said. But
Well, I'll be driving up there for Christmas.
Oh, you are?
I'm driving up there on the Saturday before, yeah.
Oh, brilliant.
Yeah, because I've got a little dog, so I can't take her on the train or on a flight or anything. So we're going all the way up to Aberdeen this year for Christmas.
You can't, if you put some dark sunglasses on, you can take a dog on the train.
There was dogs on the Eurostar yesterday. My missus was beside herself. Emma was sitting there going, hang on, if we can't take Maple, but they can take their dogs, we've got to figure it out. That was my little take home from yesterday.
Well, that was my father lost his eyesight when he was 51.
Okay.
And it was, obviously terrible, but we got a guide dog. And this was the real, the silver lining.
Yeah.
Because I'd always wanted a dog. The most incredible working pets.
Oh,
there was once he was walking up the road to our next outside our house, and Nielsen was this golden Labrador's name, and came and sat in front of him. And my dad thought he was just messing around, so kind of pulled the lead. And Nielsen walked another 3 steps and came and sat over his feet and stopped him moving again. So my dad, Nielsen, what are you doing? What are you doing? And Nielsen started brushing his nose against my dad's shoe, and it was to show him that his shoelace was undone.
Oh, wow.
So, I mean, absolutely incredible training.
Just the best. It's amazing. But the reason why I asked that is, the 16th, 17th, you're looking at that end of the second week of December. The reasons why the Santa Rally occurs is it's become a bit of a self-fulfilling prophecy. So I actually think it now is more, it occurs because it has occurred. So if you think about passive funds, you think about the way that we manage our money these days is, 401ks in the US, ISAs over here, pensions will typically allocate at the start of each month. So you typically see a start of the month effect as everyone gets paid. You typically see people get paid a week early in Christmas, so maybe that contributes.
Yeah, that would make sense.
Maybe that contributes to the lift effect. But people will often talk about fund managers wanting not necessarily to window dress, but wanting to end the year on a high. You typically see in big kind of institutional money walk away, so the liquidity is lower at that time of year. And as liquidity is lower, retail investors have got a bit more oomph in the market. So if you get that flush of retail money in that middle of the month, then you tend to see it kind of move slightly higher. But I do think it's a thing because it has been a thing. And I think so many algorithms now are set to follow seasonality trends that it becomes self-fulfilling.
Yeah.
But that means you get it
until it breaks.
Until it breaks, and it's not every year.
Yeah, 2022 down 6.5% in December.
Yeah.
2018 down 10.5% in December.
Correct. Yeah. So it's not, causation doesn't mean. Is it correlation doesn't mean causation?
That's exactly my girlfriend's favourite phrase.
Yeah. So be aware that Santa doesn't always come, but when he does, you're probably looking anywhere between kind of 1.5% to 2% from the middle of the month into the end of the year.
Officially, absolutely officially, the Santa Rally is measured from the 23rd this year, because it's the 23rd, 24th, 27th, 30th, and 31st. So it's those 5 days.
5 days.
The last 5 days of the year. Right, a couple of questions there. As yesterday, Chris was saying his review showed it was from the period between Christmas and New Year. No, not the first week in January. So it's just the last 5 days of the year. And yet, BHAS also asking the DAX. There's a lot of focus on this DAX. Is it finally exhausted and ready for a crash or a pullback? Is that going to happen before Trump takes charge as well?
I'll have to have a look, because that was Chris gave me that data. So I'll have to have a little look at and check that that's still legit. But there is a section on our website. If you look at the website, not necessarily in the platform, there's a piece on the Santa Rally. And I imagine we'll be covering it more and more as we kind of trend towards that time of the year. So watch this space.
There, aren't we? 10th
but the official, do you know where the Santa Rally came from? Where the term came from?
I know the rally monkey.
The rally monkey.
The rally monkey is.
the rally monkey,
I got to get. Well, you explained where Santa Rally came from. I'll find the monkey.
There was Jeffrey Hirsch was a he was originally managed his own money, and I think he did run some money for a while, but he then became an author and a writer. And he was a bit of a fundamental / technical investor trader.
Okay.
And every year, the Hirsch Foundation now, because it's run by his son Yale. In fact, excuse me, no, it was Yale Hirsch initially, now run by Jeffrey. I was corrected by this on the pod. Clearly, my notes are not up to date. He puts a book out called The Stock Trader's Almanac, and it's a brilliant look up on all things seasonality. So it gives you a fact or a market idea every day of the year. Based on historical trading. It's a brilliant book if you can get it. And I believe the 2025 edition has just come out.
Let's have a quick check, because it is absolutely.
It's fantastic.
Love this thing.
But Yale turned the phrase. So yeah, there you go. So Stock Traders Almanac, Yale Hirsch, the original almanac writer. A Santa Claus rally is the sustained increase in the stock market that occurs around the Christmas holiday on the December 25th. Most estimate that these rallies happen in the week leading up to Christmas, while others see trends that begin on Christmas Day through Jan 2nd. So even back in I think it was the 80s when they started to take a look at this. You are right, AP. They did originally say Jan 2nd.
Yeah.
But just the analysis that we did was up till the 31st.
Right, let's get the old rally. So this on the trade floor at Credit Suisse, this came out on a Friday after non-farm Friday. If the market was rallying, then it would be played, and you can hear the. Yeah, so there's the rally monkey comes out on the big days when things are going well.
What's the inverse? Is there a hanging monkey or something? Like when it's like a crash day.
Shall we find one?
I don't think we should.
Let's find one, because it's coming. There's going to be a day soon. People are talking about the DAX. You know, I'm focused on the S&P. Of course, Monkey Man. I didn't even put 2 and 2 together. He's saying there's his brother on YouTube. Good stuff. Right. So we quick time for question 2 then.
Question number 2.
Right. How does interest rate differential strategy relate to the concept of the carry trade? There's a lot of Scottish words in there.
There is a lot of Scottish words in there. So the carry trade is it's an idea that you can borrow one currency and pay an interest rate to receive a currency, and then lend currency in another country. Sorry, the other way around, yeah, lend in one and pay in the other. So ultimately, the design is if you can receive interest at a higher rate in one country by borrowing in another country and paying less, you could then in theory sit there with no market risk, but all you're going to do is you're going to pick up the benefit. Let's say you're receiving 5% in one country and only paying away 1% to borrow in another.
Yeah.
You're then capturing a carry of 4%. The carry trade has been made famous recently by...
August the 5th.
Sadly, August the 5th.
Oh, I thought you meant my TikTok.
No. When did you put it? Was around.
So my TikTok that went viral.
Oh, the rice TikTok.
The Japanese yen TikTok.
Yes.
But it started with a bowl of rice with ketchup in the middle to represent the Japanese flag. 3.9 million views, 160,000 likes. But it was the kind of TikTok that, you know, brought me to where I am today.
Was that your interview, basically?
Yeah.
Look at what I can do. Look. But it
wasn't just all of Scotland. It was, 4 million people around the world.
Yeah, exactly. Yeah, well, good. 4 million people. That's pretty cool.
Yeah, that was a surprising couple of days.
That's pretty cool. But the premise being that Japan had negative interest rates, I believe at the time, or was it 0? They moved to 0.
0.25 perhaps. Yeah, something like that. Yeah.
So you could borrow yen for very little, very, very little in cost. And then what you would do in theory is you could do it 2 ways. You could just borrow those yen by lending dollars and then buy Japanese equities. What we also found is that those yen were used, those dollars that you now had were used to then go buy US assets. And so fundamentally what happened at the start of August was the carry trade started to It didn't break. There was a huge kind of shockwave through the market.
Yeah.
But the margin you were then earning, you had the Federal Reserve say that they're going to start to reduce interest rates. So all of a sudden, the interest that you're receiving was being reduced. At the same time, you had the Bank of Japan, say that they were increasing interest rates.
Yeah.
So your cost of doing business has increased. So your margins, your profit margins have decreased. Trigger selling of US assets, selling of Japanese assets.
Well, not just that, because obviously you've got the currency risk there as well.
Oh, yeah.
And so the currency moved from 160 to 152 in a very short space of time. So you're making 5% in a year on the interest rate differential, and you had a 4% move in 2 days of the currency. So yeah, we woke up on that Monday morning. Oh, I was short puts on Nvidia, and I was long some Bitcoin. And I think Bitcoin was down 15%, Nvidia was down 12%. So I decided to go and make a TikTok.
Yeah, great. I tell you what, I'm going to show you something cool on the platform. If you were to go to the IG platform and go to watch list for me, on the left-hand side, just click on that star. Yep.
Okay.
You see we've got, on Discover at the bottom, we've got a watch list that we've created for you called Major FX.
Major FX.
Yep. Now add that to your workspace for me, just as an example. And what we're going to do is if you just make that window a little wider for everybody. Yeah. Now at the top left of the market there, you can add and remove columns, of which swap bid and swap offer. Did you see those?
I've never seen this before.
Swap bid and swap offer, please. Now, what you can see there is it has added a column to your watch list that shows you the amount of points you would make or receive overnight for being long or short that currency.
Really?
So if you take sterling dollar there, cable at the top, if you're short cable, if we assume £1 a point or one lot at £10 per point, you're going to get paid 0.42 times your trade size per tick. Sorry, you're paying, it's a negative number, excuse me. If you're long, you're also paying 0.38. Now that's because UK rates and US rates are fairly similar. So there isn't a huge edge, the carry trade there. Going down to dollar yen,
God, this is brilliant.
it's a different picture entirely.
Yeah.
If you're short dollar yen, you are paying away 2.36 times by your trade size.
Okay.
But if you're long the pair, you're receiving 1.44 times your trade size.
If I am short, so if I'm, because I'm then long yen. Yeah, by
Correct.
shorting this, I go long yen.
That's right.
Yeah. So I receive, no, sorry, if I'm long dollars, so if I'm long this, so if I'm go long this, then I receive 1.44. If I'm short this, I have to pay 2.36 because it's such a huge differential.
Correct.
Excellent.
Yeah. So what you
I'm
tend
going to leave that on there.
So what you tend to see if you go into the more exotic pairs against the dollar, for example, you tend to find some pretty fruity carry trades.
Like Australia just now, I guess.
Well, you can see there, Aussie US, there's not a huge amount, but I would imagine if you were to look at something like a
Aussie yen.
Yeah, Aussie yen, or there you go, look, you've got the Euro yen effect as well, so 1.87 payable, 0.89 receivable. And these rates update in real time. So not in real time, I think they update just before we get an indication by about 8, 9 o'clock. So these will be yesterday's rates. And then depending on what we see from our banks that we trade with, we will then update these just into 10 o'clock, which is if you hold a position through 10 p.m, these are going to kick in.
Right. So if you put it on at 9:30 and took off at 10:30, you benefit from it.
Correct. Yeah, but just be aware that the spread will have an impact at that point.
Yeah.
You're trading at 10 o'clock at night. Most majors are not in their main session, so the spreads may be a little bit light, a little bit wider. So you just want to be sure that double check where your swap bid, swap offer will be versus the cost of doing that trade.
And obviously if you put it on at 3 p.m. and took off at 4 p.m, there's no overnight.
Correct.
Yeah.
You've just got to hold your risk through 10 o'clock.
Fascinating. Good. Right. Excellent. Look, thank you so much. Learned something there.
There you go.
As I did with many Yeah, we still didn't come to where Mondelez was
where was it
listed.
traded?
We
Yeah.
did. I did find the graph. It must be in the US, is it?
Let us see. MDLZ. Yes, Mondelez.
Yeah, there we go.
There you go.
Good stuff. Right, now you're joining me for the tasty teaching
We are
later this afternoon.
got a group of clients coming in that are all options traders with us here at IG. Very keen to get stuck into the tasty product. So we're running a focus session. Should we call it that? A
Workshop.
workshop. A repeat of the show that we took Tom and Rich on tour with a few weeks back. God, it was probably about a month ago now, wasn't it?
Yeah, it must have been. Yeah.
So the people that couldn't join the show, we've invited them in to come and take a look at us here in the office.
So yeah, a deep dive into the Tasty platform, because it can be quite intimidating when you first look at it. You know, it's
What did you say? When you were selling it to me, you said when you look at the Tasty platform, it's like walking into the cockpit of an F-14 or F-19. Or
exactly, yeah.
And now you know how to fly it, which is bold.
Yeah, or at least I know how to get it onto the runway. But yeah, you can see here. So yeah, basically teaching people to go through all the watch lists and you know what's on the right hand column, how the P&Ls work, the BPRs, the margin equivalent, all like that. So that's later on today. We've got 10 people coming in. Is that right?
About that. Yeah, I think about that. Looking forward to it.
AP
as well.
AP's joining us.
Perfect.
So, Alex, we'll see you later. Now, just one last question away from the numbers. Exactly, that Vodafone update yesterday was largely irrelevant. The important thing is to wait and hear from the Italian regulators, and that was meant to be today. So let's hope that the Italian regulators are on time with that update, and we'll see by the end of the day.
Well, BT,
Vodafone.
Well, BT have bounced. They're now down 1.2%, and Ashtead are continuing to get hosed. They're down 10.
Ashtead down 10. Wow. That the market is not enjoying any profit warnings at the moment, is it? It is not taking them lightly, as we saw with JD Sports, as we saw with Fraser's Group last week. There we go. British Land up 90 basis points, but yeah, BT only down 1.2. That was a bargain, down 3. Could have traded that. Good. Right. Excellent. Let's let Angeline and Tom get in here, shall we? So we'll go for a quick break, do the changeovers of microphones, and I'll see you later on in the programme.
Thank you. Bye-bye.
Hi, I'm Sean Mearson, Senior Market Analyst at IG, and join us for our new show, Charting Essentials. That's every fortnight on IG.com, our trading platform, as well as YouTube. And that's a show where we look at everything technical analysis, hoping to help you upskill. Whether you're starting out or just looking to level up, we got you covered. In each episode, we'll break down complex concepts into easy to understand lessons, provide practical tips to help you sharpen your chart reading abilities, explore powerful technical indicators and their real-world applications, as well as guide you through hands-on examples to reinforce your learning. So come, let's work on our skills. Let's get better at this. Let's accelerate that trading journey, learn to have confidence to trade, and make informed trading decisions.
Trading the news is an essential skill for all traders. Major news announcements can often cause large price movements, particularly in Forex markets. So, here are 5 key pointers to help you try and make the most of those moves. 1. Do your research. Know the times and dates of important events. Use an economic calendar, for example, the one on IG.com. It's a vital tool to help you plan ahead. There are many announcements on any given day, and it's essential you know which will affect the assets you're trading. For a Forex trader, Generally, any event impacting the US dollar is important. Events like non-farm payrolls, Federal Reserve minutes, and GDP. If trading shares, look out for company earnings, dividend payments, and stock splits. 2. Check what the market expectations are for the event. Look at a chart of what happened last time. How did the market react? Was the data better or worse than expected? Did earnings beat or miss estimates? Use what happened in the past to inform your future trades. 3. Study related news and events. What else could impact the market in the wake of the announcement? Take crude oil as an example. US inventories are due on Wednesday. If there's an oversupply, the price should drop. But say OPEC ministers are meeting Thursday. If they reduce output, the price could rise. So, it's essential to look at the overall picture and not take each event in isolation. 4. Put a strategy in place. Know what levels you want to buy or sell at and where to put your stop losses. This will help you to have the courage of your convictions and avoid knee-jerk reactions. And finally, 5. Learn when to fade the news. Here's an example. The CEO of Company X announces he's leaving. The stock falls, but you believe the company's fundamentals are still sound and the market is overreacting. So you hold your position. If you're right and the price rises, you could profit. Of course, if you're wrong and the price continues to drop, you'd make a loss. Remember, these are all just guidelines. While trading the news can be exciting, it is also risky. Unexpected results can lead to high volatility in the market. So, make sure you're well prepared, and always have a solid trading plan.
Hello everyone, trader friends, welcome back. It's Tuesday and we've got Takeover Tom with us, fresh from now his DIY pizzazz move, because he's now doing up the place that he's just moved in. How's it going?
Well, I've never done DIY before.
Really? You look quite handy.
Thank you, I appreciate that. I thought you would have said the opposite. Shall I show you my...
Never mind that he's got really soft pink hands here, people.
This might not look like much. This is my...
Can we put up his screen?
So, it doesn't look like much, but...
What on earth?
It doesn't look like much, but this is my attempt at paneling. And I ran out of MDF strips. You can see the top right, I've just run out of strip there,
yeah.
Which is really annoying because I've now got to buy a whole new pack of MDF strips. But what do you think? I've had to use things like filler, the glue that comes in the big tube, like, you know, with the gum thing. I've had to use all sorts here. What do you think?
How long, yes, Fred's asked the right question. How long did it take you? And are you telling me you just glued it to the wall?
Yeah, but with proper, like, you know, the tube of like a no more nails type thing.
Okay, please tell me you are going to secure these with screws?
No. It's not called add more screws, is it? It's called no more nails.
Yes, but no more nails don't actually work if you put too much weight on it. So what exactly are you going to put on?
No, this is just for decoration. It's paneling. So I'm going to paint it.
Okay.
I'm not going to hang anything on it. It's not like a...
It's not like weight bearing or anything.
It shouldn't. It needs to bear its own weight. That is all.
Okay, and also just to quantify, trader friends, know lots of you are very handy here, as I am. You're not going to, you're not going to like kind of put, you know, no more nails should actually be relabeled as only as good as your paintwork.
Oh, I see. Yeah. Because if the paint can come off.
Yeah. Then your no more nails is like.
Well, I mean, look. So it's been stuck on for 24 hours now, and it hasn't fallen off. And I now need to do primer, I believe.
Oh, yes,
I'm getting all these tips.
Did you use MDF? Did you cut that with your own fine hands?
I'm like kneeling on the floor, sawing wood on a piece of skirting board.
Okay.
So it's not the safest operation. I tried to buy a circular saw, which I thought
You can't kneel.
My wife wouldn't let-
with a
wouldn't-
circular saw. You need a workhorse.
No, I know. But I wanted a circular saw, a mitre circular saw with this. I wanted one of those. Wife was like, no, that's too. You're not competent enough for that yet. So I didn't buy one of those. So I'm just manually sawing. I'm manually sawing, and look, I'm excited to show you what it looks like when it's finished because I think it could look okay.
Amazing. What's your next project then? What's after this?
Well, it depends how this goes, I think, because if this goes really well, I will then continue my paneling experience around the house.
Okay.
If it doesn't, then I think I'll just be.
You go home and the paneling has fallen off.
I think I'll get home and there'll be a registered professional there probably,
All right.
ready to take over.
Speaking of which, one of the biggest fallers today is Moonpig. I did want to buy you a Moonpig card. Moonpig.com, right? Down more than 10%, among the biggest losers, and this is due to problems in its gifting unit. I think the key here is that it is now experiencing a longer timeline, it says itself, for revenue growth, and that has come a bit of a shock to the investors. Let's have a look at how big a shock, because we are seeing that big red line there, trader friends, down 10.5% now, so a bigger fall than before. And this has come, it has been said, after quite a long rise in the share price. This has been a darling of the city for a while because they've been quite innovative in its gifting products, especially leveraging the usage of pictures and making bespoke gifts. However, back to me, guys. I do have a gift for you. But
what?
Before you get, I don't do wrapping. I'm sorry. There's not enough
Moonpig
time.
And you can add a little bottle, tiny little bottle of prosecco as well. But anyway, that's fine.
I don't do wrapping. I don't. You can ask my family. You've met my husband actually. I don't do wrapping for anyone, not even him.
He's always said that. He's always said you're lovely, but you just will not wrap.
Already have me. Don't need any other wrapping. But I'm always function over form.
Okay.
And I thought, what does Tom work from home not have 2.5 weeks to? Is it 2.5 weeks of Christmas?
Sounds
Well, you
about right.
might not be able to
15 days.
find it in one of your boxes. So.
This is for me?
Yes.
Shall I open it here?
Yes. Open it. Open it. I hope you haven't.
Very exciting.
It is.
An early Christmas present.
It is useful. Monkey Man saying you can overdo paneling here. Have you got one yet? Have you got a pair yet?
I don't even know what it is. This is some kind of, I don't know, sadistic mechanism for torture from the Victorian times.
It's a turkey lifter.
Oh, wow. Okay. Double-pronged turkey lifter.
This is also a hint that you're going to invite me to come over
Yeah.
when you're hosting and dining in your palace.
And we can sit on the floor because we haven't got a table. but at least, so I haven't got a dining table, but
Okay.
I can lift my turkey.
That's great. That's like a trading metaphor. I don't have a table, but I can lift
That
it.
is actually very useful because even with a chicken, I tend to just put a fork in the cavity to try and lift in it. The juices, it's a nightmare, isn't it? So that's actually very helpful.
Yeah.
So I really appreciate that.
Also, if you have any interlopers or anyone, you need to defend yourself.
Interlopers,
Yeah.
like marauders, attackers.
Yes, then you can defend yourself.
Yeah, that's true.
Sure, trader friends. Look, that.
Here we go. I think I could take out a couple of marauders with that.
But, hey, you're
One in each hand.
yeah, you may be sitting on the floor this Christmas, but
But I'll have a very well lifted turkey.
yes,
I don't know what I'll lift it onto, but at least I'll be lifting it.
yes. Speaking of which, we've got Tom here for a very special reason because we have so many of our trader friends out there asking, right? What's in store for 2025? We've had a lot of talk about seasonality here on IG because we want to give our trader friends a heads up. If you're trading the Santa rally, then which day is optimum for that trade? If you're trading FTSE, if you're trading S&P, but I want to get sort of like bigger picture with you, right?
Yeah.
So we've talked about small caps versus the usual suspects like S&P, NASDAQ. Those of you that came to the Tasty event where I was there, Tom Sosnoff was there, Rich was there as well. You watched him talk about his contrarian trades, and he put on a trade Russell versus, I think it was S&P 500.
Yeah.
So is 2025 going to be the year of the small caps?
Well, that's a good question. So I think, so we know that this year, Russell 2000, which is a measure of the US small cap stocks, hasn't performed as well as the S&P. S&P, I think, was something like, so year to date, S&P up 27% compared to the Russell, about 19% up this year. But what we do know is that as inflation cools, as interest rates go down, that's often good for small caps, right? Because they can raise money at a cheaper rate. So if we take a quick look at the Russell, if we bring up my screen, if we look at the Russell, does this immediately scream anything at you? So this is looking kind of since the beginning of the year. Does your technical analysis brain scream anything here?
Upward trend.
It does. And having told you previously that I'm not much into technical analysis.
No, you poo-pooed it.
I did, but I did poo-poo it a lot. But I've started to get into it a little bit. So if we look at, for example, our Bollinger Bands here on the Russell 2000, we can see at the moment, bang on the moving average there in the middle, not close to either the upper or the lower band. Another one I think I mentioned last time, which I'm quite liking, is our moving averages. If I look at this over, if I change this to 100, no, I'm going to change it to 50 and 200, which is quite a good way of checking it out. And I turn off my Bollinger again. You can see there's not looking like a crossover there.
No.
So that's going particularly normal. And then if we look at a third one, our relative strength, as we spoke about last time, if it's pushing 70, it's overbought. If it's pushing 30, it's oversold. But it's right there in the middle. Currently, it's sitting around 54. So nothing wild happening there. But the theory stands that as we move forward, if interest rates come down, typically good for our small caps. And the Russell 2000 is a measure of those small caps.
Yep, and interestingly enough, it has, so far, year to date, it is underperforming the S&P 500. Year to date, Russell 2000 up 18%, and for the S&P 500, it is up around 26%, I believe. Yep, 27%. And there's this talk that, and I believe anyway, that you can't have, you don't have trees that grow into the sky. And at some point, the S&P has to correct.
Yeah.
I don't think it's going to be before Christmas. Let's be real here. I don't think that's quantify it. I don't think it's going to be before Christmas. I think it's going to be possibly before Christmas and maybe depending on what Trump says in January, right? But given all that, would the Russell 2000 be a good way to hedge that, to step out of the S&P into the Russell? I mean, maybe that's one way of doing it.
It is, and you could do it. You could do it on the Russell index. You could also do it on an ETF as well. That's obviously another way of doing it. So you could either buy the underlying ETF or you could spread bet on the ETF. Another thing I was going to look at is if we look at the client sentiment on the Russell, if we just bring that up, so we can see at the moment, 68% of IG clients long the Russell at the moment, and as of the last hour today this week, we're sitting kind of around 50%.
Was that just your trades alone before you came on?
That's just me, just doing 50% of each.
Yeah, and that's a good one to watch. I quite like the circle doesn't really do much for me, but I do like the change on the right-hand side, the last hour and today. Also, you mentioned ETF. So there is an iShares Russell 2000 ETF. If you look at my screen here, which I'm adding for you, which if you, like Tom said, if you don't want to, buy the underlying, you wanted to ride an ETF, this is also a good one to watch. And there's an all sessions version, plus there is a non-all sessions version as well. What's key too is you talked about the RSI. At the moment, it's mirroring it nicely, right? I'm just looking at the ETF here as an example because, it roughly follows the Russell 2000. But as a technician, what I'm also looking out for, it hasn't happened yet, but is a divergence. So if you see higher highs on the price action, but lower lows, for example, for the RSI, it's starting to diverge, then that heralds a change in the trend. Currently, we don't have that yet.
Say that again. If what diverges from what?
So if the price action, if you have higher highs,
Yeah.
and then for the RSI you have lower lows,
Yeah.
and they're going in opposite direction, so a divergence.
Yeah.
So for us, that's like red flag, watch out. There could be a change
Okay.
in the trend. So at the moment, we're not seeing that yet. So that's good. That means the trend is still in play.
Okay.
Game on, right?
Game on.
Game on.
So that's small cap stocks. The other thing I wanted to take a quick look at was dividend growth stocks, because high dividend stocks can be, a hedge against market volatility and things like that. So if we wanted to have a look at high growth stocks, if we just bring up my screen, you can do it quite easily. So if I look at dividend yield here, and if I go for, so we've classified very high as more than 5%. So essentially, if we look at these, we're seeing our big dividend yield stocks are things like Verizon. You've got 6.3% yield on Verizon, HSBC, Pfizer, and BHP. Those are your high dividend yield stocks at the moment. And then something else I thought was quite interesting is you have this ETF. This one here, VIG, which is dividend depletion ETF. If we take a look, so this is a collection of.
Is that Vanguard?
Yeah, this is a collection of stocks where the dividend is growing. And if we take a look at this one, what's interesting here is if you look at client sentiment on this one, 100% long on this one, and this is stocks where the dividend is growing.
Nice. I like that. That's a really handy one to look at. I'm going to write that down right now. Specialized funds. Interesting. Does it tell you what the constituents are?
No, you'd have to look. You could Google it and you could look up what the constituents are.
Let's see. Vanguard Specialist Funds.
VIG is its ticker.
EIG.
VIG.
VIG. Vanguard Specialist Funds. I always like looking at the constituents because sometimes it's really a nice way for me to kind of look at it to see whether I already hold some of these stocks or to see how they've mixed it up.
Yeah.
Right, here we are.
See how the clever investment manager has picked them.
So it has a large blend. And
Should we bring it up?
let me see if I can bring it up. There we are. Fund management run by Vanguard Equity Index Group, of course. $202, that's the market price. Where is the market cap? I don't see that anywhere. It's done quite well. Look at that since inception. Look at the 1 year, 26.7% year to date as well. Splice, let's see whether we can see the constituents. Where are we? I love how...
There you go, along the top, portfolio composition.
Ah, here we are. Thank you. 338 stocks. There we are. 210 billion or thereabouts market cap. Still don't see any companies, do you? Ah. Right, so okay, sectors, communication services, discretionary, consumer staples, also energy. Ah, here we go. Apple, Broadcom. Here we are.
There you go.
So this is what I mean, trader friends. It's always good to look at the main constituents because, like, for example, in my case, I already hold quite a large tech. I've got quite a big tech skew to my portfolio. So already lots of Apple and lots of Broadcom and Microsoft. But this has got some interesting names. I don't have Home Depot. I don't have MasterCard or Visa as well, but I do have United Health and Exxon Mobil. So yeah, some really well known names there. And I guess they're being kept in that portfolio for their dividends, right?
Yeah, and I mean, look, it's what an easy way to have exposure to a wide range of high dividend stocks just by the ETF. It's so much easier, isn't it, than doing your own homework, finding all the high dividend stocks yourself. But what a pain. Someone else has done it for you, but obviously you pay the fund management fee, wouldn't you, if you bought the ETF? But it's an easy way.
Vanguard, and boy, do they get paid well there.
Yeah, yeah.
It's like hiring someone to do your paneling.
Yeah, which I haven't done. So maybe, you know what? If I'm going to do my own paneling, I should pick my own high dividend stocks then, shouldn't I? Which is cheaper? I don't know.
Speaking of which, is there any? We've been talking about small caps and everything. Is there any seasonality or any kind of timing that you've looked at, or is this basically a sit and hold for all of 2025?
This is basically looking at the fact that interest rates are coming down. That's pretty much why I was looking at these two things. That's purely it. So not an entire 2025, more just looking ahead as interest rates get cut.
Right, gotcha. And then once that changes, of course, then this theory comes off.
Potentially.
Just very quickly before we move on to the break, we talk about seasonality and timing a lot here because timing is pretty much everything. For those of you that saw Luke earlier on talking about when's a great time for Santa Rally, I've got this handy thing that the PCMs, our client managers, handily put together because if anything, we like being detailed here, right? There's no point telling you this is a great theory, this is a great hypothesis, but no one gives you any timings, no use to man, person, or beast, woman or beast. But here we are with some dates. So it tells you the optimum times if you're trading FTSE or S&P, all the way from the 12th to the 21st. It gives you the estimated gains there. So it looks like optimum is around the 16th.
So what is this? What is this percentage?
Yeah, so it shows you, they've crunched numbers to show you the gains per day if you were in the FTSE or in the S&P 500. Because they keep...
But how have they done that? How have they done that?
Well, that's why you have to... This is my cue. They've told me, don't give it all away, Ange. We have to go to break. They're telling us to go to break. Don't give it all away, Ange, because this is precisely when I say, and you have to watch their podcast.
Ah, right. Okay.
Talking Heads.
So it was a little cheeky little plug. Okay.
Yeah, Santa Rally.
They've paid you for that, I can tell.
Yeah, in more than turkey lifters.
There's nothing better than turkey lifters.
So I'm also going to show it to our trader friends because a lot of people ask me, how do I find it, Ange? How do I find it? So here we go. Talking Shop IG podcast. And right at the top, can you see there on my, I've just searched that and it's right there at the very top. Click on that and right at the very top, Santa Rally Secrets is where it will all be revealed.
Wonderful.
And on that note, show us how the paneling goes.
Will do.
Monkey Man is asking, he wants to see the progress as well. I do. Tell us.
I'll keep you updated. It's driving me on to get on with it and get it done, so I can keep you updated.
Thank you, Adam Deleuze, for all the numbers for Mastercard, Home Depot, Procter & Gamble as well. I guess those numbers are in terms of the dividends. And also, thank you for showing us the ETF. I didn't know that existed until today.
Wonderful. It's always nice to see new things, isn't it?
Right. We'll be back after this break.
Hi, I'm Sean Mearson, Senior Market Analyst at IG, and join us for our new show, Charting Essentials. That's every fortnight on IG.com, our trading platform, as well as YouTube. And that's a show where we look at everything technical analysis, hoping to help you upskill. Whether you're starting out or just looking to level up, we got you covered. In each episode, we'll break down complex concepts into easy to understand lessons, provide practical tips to help you sharpen your chart reading abilities, explore powerful technical indicators and their real-world applications, as well as guide you through hands-on examples to reinforce your learning. So come, let's work on our skills. Let's get better at this. Let's accelerate that trading journey, learn to have confidence to trade, and make informed trading decisions.
CFD trading is the buying and selling of CFDs, or contracts for difference. As a derivative product, CFDs enable you to trade shares, indices, forex, commodities and more without ever needing to own the underlying asset. When you trade CFDs, you trade the difference in the price of an asset from the point at which the contract is opened to when it's closed. As you don't own the underlying asset, you can trade markets that are falling as well as those that are rising. So, how exactly do you trade CFDs? Each contract has a buy and a sell price. Sell prices are slightly lower than the current market price, and buy prices are slightly higher. The difference between the two is referred to as the spread. If you think the market will rise, you would buy. This is called going long. If you think the market will fall, you would sell, known as going short. The more the market moves in the direction you predict, the larger your profits. If it moves in the opposite direction, the greater your loss. CFDs are traded on leverage, which means that you only need a small deposit, known as a margin, to gain full market exposure. So, if you wanted to open a position equivalent to 500 Apple shares, you might only need to put up 20% of the cost. Your profit or loss is calculated based on the full value of the trade, however, which could mean magnified gains, but also magnified losses. So, when trading CFDs, you should always keep an eye on the potential downside. Take care to manage your risk with stops and limits. Visit IG Academy to learn more.
Hello everyone, listen up, listen up. We are Trade Live from IG, and this is the section where we go live to the trade desk, and Monty Safi-Eddin is joining me now. Monty, how are you? How are things over in the UAE ahead of Crimbo?
I'm doing quite good. How are you guys doing out there?
We're good. Everyone's sort of, we're in the hecticness of the year end, as I'm sure you are aware of, and also the number of, outlook pieces. We've got a big fat pub quiz coming up. We've also got numerous guests and customer and client events. So tonight is the big Lord's Do. This evening, as you can tell, I'm kind of slightly already losing my voice, but it's all good stuff, and how about you?
Quite good. I don't think it's going to be as busy on mine as it is on yours, though. I like how earlier in the show they're saying that Monty from the Middle East is going to be on the show to talk about, and he said sentiment. I thought for a second he was going to say Syria. I was like, no, I'm not talking geopolitics. That's not happening. Sentiment is all I can really talk about. Yeah. Plus, I got my product placement here. Well, there's the IG logo, and then this one they gave it to me when I joined. So just in case it wasn't clear to everyone out there that this is Trade Live with IG. Just in case it wasn't clear, the product placement is there, and I'm ready to go.
Fantastic. Always counting on you to, especially with your American background, sport. I do miss that. I miss the fact that everywhere you go in the US, there's some sport going on. I've got your daily market report up, speaking of sports, so it's game on into 2024 year end, into 2025. Talk us through what it's showing us.
Yeah, I mean, look, the story was going up is when you have this big run when it came to indices, right? Record high after record high when it came to S&P, NASDAQ, Dow, so on and so forth. Generally speaking, by default, traders on our end have a tendency to want to range trade when it comes to most indices, and they have, or at least attempt to try and range trade and work their way out of any situation that they might get into. I mean, the same thing when it comes to FX, by the way, which we spoke about before. It's a bit like, it's like when you know someone you shouldn't get into a relationship with, you've heard some bad rumors, but you just do it and you just jump in anyway. And then as you're with them, the negative rumors start to come to light, like, oh my God, it turns out he's as abusive as they say he is, or all these rumors will start to come out and stuff like that. And then the reality, I think a lot of it is that people jumping in and going, okay, I'm going to try and range trade it, but it just kept on trending higher. And so you saw them go to heavy extreme sell territory when it came to the key U.S. equity indices, but notable exception, I got to say, was the Russell 2000. Majority buy and looking for excuses to go long. So that's one of the key exceptions. And I got to say, Christmas has come early for those of you trading HS50 because they were extreme buy 82% yesterday before the announcement from China about the fiscal monetary easing, or with what's coming in 2025, and they've dropped from 82% to 67% in just one day. So there's been, after that big pop higher, they've been holding long positions for a long time, waiting, just when are these relatively, in terms of PE ratios, relatively undervalued stocks going to finally have their day. They had a good day yesterday, and I think that was a good chance for a lot of longs to want to get out, given there were a lot of mostly range trading opportunities prior to that. So yeah.
Now, the key words that you uttered there that piqued my interest is you said seem to want to go long. Does that mean that they shouldn't? We talk a lot about seasonality here. I don't know whether you heard Luke earlier on, and also myself and Tom. Tom certainly with you on the small caps Russell 2000, likely to make more gains next year, depending, I guess, with the S&P and the Nasdaq now looking overheated. We keep saying it can't keep continuing like this. In fact, Monty, I was at a party for my sins on Saturday with lots of UBS and HSBC private banking people, and they were saying, like, they're all kind of like, wow, we didn't expect the markets to continue higher for so long.
Very true, very true. It's kind of, how they say, like, for the S&P 500, what is it? The historic PE when we're not in a recession is like, what, 15.6 or something, right? So then, it gets to 16 and everyone's like, oh, be a little careful. And then it got to like 18. It was like, oh, be careful.
Yeah.
It's gone to 18, it's a bit over. Then 21. It reminds me of like when I'm in the US and like when you're about to hit 16, like, oh, be careful, he's about to get his driver's license. This is a very dangerous time. 18, oh, you can place a wage. 21, liquor license, be very careful. And the guy gets to 24, like, what's the S&P now? The Ford and the Treads, like, 23, 24. It's like, oh yeah, what's going on? I'm fine. Everything's okay.
And I got rich in my head going, yield, bonds, right. Yeah. So
yeah, absolutely.
Yeah, and so you're saying that the child, the boy, or the teenager graduates and starts driving, and it's still okay for quite some time. Is that what you mean?
And then the odd part is that by the time they get to like 24, for example, and it's like, yeah, I passed that whole period and I'm totally fine. Why were you guys worried so much about it? That's kind of what it is. And everyone's like, yeah, the S&P, it should be at 16 or 15, but we're at 24. Everything's fine. We crossed this path all the way up here. I know that it's a very, very tricky time. And I noticed also in the comments for the show that some people talking about, when is one of them mentioned the DAX, when the DAX going to have its drop. It can't keep going up like this. I think a lot of them are looking at most of these overvalued, the ones with higher PE ratios, and going, okay, when are we going to finally have it come back down? And they're shorting into that. Whereas maybe they looked at the Russell 2000, not in terms of PE, but just in terms of expectation that it's going to finally outperform, or finally that spread between the Russell and the small cap and the large cap might finally narrow. That might be a reason why, but I'm noticing also that looking at the yellow dotted sentiment line, that what they seem to be doing is they're trying to trade this somewhat bull channel. So every time it drops, they sort of go long, and then afterwards, if you go to US Russell 2000, it's on page 5, and then afterwards, whenever the price goes back up, you see the longs getting out and shorts getting in. So it's interesting that they are actually trying to trade this channel a little bit better than what I've seen with some of the other key US equity, where they're just generally looking to short regardless of the channel, regardless of some of the key levels. I mean, for the DAX, it got, they were extreme short at one point, 85%. I think got to 87%, excuse me. And then now they're, as of this morning, they're around 86%. So Russell, yes, that's the DAX now. Yeah, interesting to know. Like that's, they've shorted. They were range trading before that, and you can see the yellow dotted line go up and down and up and down and up and down, and then price goes up. Longs get out, shorts initiate, and that takes the bias. That dotted line takes to the left axis. You see them going all the way to just 16% long, or now 14%, which means that means their opposite sell 86%. So they're very much waiting, hoping for some sort of relief to happen. And the DAX going this type of run higher, record high after record high after record high. When is this going to be undone with all that's happening globally, right? And I think that some of the, when it comes to European equities, the story that I've heard for European and as well as Asian equity, Chinese equities, it wasn't a matter of the news is good, so get in there and buy the equities. It was more a matter of the news might be so bad that means that they're going to have to do more easing or more rate cuts, which should be good for shares. That's kind of the narrative that they're taking. In other words, they're anticipating that the whole good news is bad news narrative is going to hold, which is always something you want to be cautious about.
And with the potential change that Trump might bring in January, inflationary potentially, and also that might cause a stronger dollar than we're already seeing right now. We've been talking about, pairs trades, how to position for that. I'm looking at potentially DAX will be the beneficiary, and shorting the CAC, for example, because of its turbulence there. How do we trade like the US indices selfishly and without any sort of I like the Nasdaq. I like the fact that a lot of the stocks, the tech stocks I understand, are on the Nasdaq. Are we in a situation there for the Nasdaq where it's kind of like that 24-year-old and actually this is an okay place to be and it will continue to kind of melt up?
Well, I think a part of it is that, okay, I know that whenever valuations go up, then price to earning. If you're looking at trailing earnings and those are fixed, if price is going to go up, then the P ratios are just going to naturally go higher. If you look at the forward P, I'm noticing that the gap is actually wider on some of these key equity indices because they're anticipating significant growth when it comes to earnings in the future. Now, whether it comes to pass or not is another story. So I think that for those that have taken this idea, this narrative that they're a little worried that with Trump coming into office, the squeeze is going to be on for some of these other areas. But you look at investors, and for now, they're still piling into U.S. equities. And by default, even on our end, when clients come to our end for the physical shares and physical ETF side of the business, when they come in, a lot of them are just saying by default, I want a piece. I want a piece of the action of what's going on in the U.S. Now, whether it's a momentum play, whether it's an AI play, whether it's because sometimes they'll mention to say like we're a little bit uncertain about for example, energy or some of the other geopolitics when it comes to China, for example. So therefore, we're going to step away from all of them from an investor standpoint. So I kind of want to see first U.S. investors stop going into the U.S. stock market, and then whether or not they're going to get out. And I think it's going to take a lot for that to happen. You need to see a big unwind, not just in terms of momentum and this record high after record high, but I think there needs to be an unwind in terms of the AI play or the AI trade, because otherwise they're going to say, even the naysayers are saying, I don't want to miss out on the next rally. That's their biggest fear, right? I fear missing out on the next rally. And that's why I'm staying put. Yes, things might be overvalued. I bought at a lower price. I'm just going to stay right here. I think the one key exception among the heavyweights where they're a naysayer or they're a bit worried about the stock market or valuations and have gotten out is probably Warren Buffett's Berkshire Hathaway holding a ton of, 300 billion plus in terms of cash. I think that's probably one of the key exceptions where they've actually not stayed in the market. You know what I mean? That's one of the for his own reasons, of course, but I think that's one of the exceptions. I've not seen that from most of the other investors. So that's one way of looking at it.
Speaking of which, we've got Source Branch saying and asking, hey, thanks so much, Monty. Can you access the daily market report if you're not a professional trader, as my account seems to have limits? Now, Source Branch and Monkey Man and everyone out there, Adam DeLuz, we are working on this, right? Monty and I have been in meetings with many other departments, which I've spearheaded over the last few weeks. Monty, I've got your back. Source Branch, Irish, everyone, I've got your back out there. We are trying to get CRM involved so that it becomes an easy push for Monty, because we got to get his good stuff out there to you guys. In the meantime, what I would say is any financial instrument that you want Monty to talk about or you want me to show on screen, do let us know. But rest assured, we've got your back and all those talks are underway, and hopefully we should have something for you soon. Monty's nodding there because we've been in so many meetings, haven't we, Monty?
Yeah, and it is spearheaded by, she's the one who sparked it all, by the way. She was like, we need to get this, whatever. She's like, she's really getting it done there. So, I mean, I'm not going to take any credit for all that. Yeah, exactly. It's Angeline. It's all her. It's all her. So those of you in the comments, I'm not able to see them just yet, but yeah, you can thank her for that. And you can send the, what is the heart emojis and the whatever, yeah, the usual stuff that you want to send over.
And saying thank you very much. Now, we'll get this done. Even if I fly to Dubai myself to get this done. So we've got how many more minutes, guys, in the gallery? Can't hear you. 4 minutes. Here we are. 4 minutes. So let's take a look at some of the individual stocks now. Nvidia's had a really good run. I took quite a bit off before their last earnings just because it was getting a bit too. I was getting a bit too uncomfortable, and I put it into non-tech stocks just to diversify that holding out. But how about the FANGs? What are they? What are the sentiment signals telling you as we head into the festive season?
Yeah, so when it comes to, I mean, we can start with, like, I guess Tesla's a significant one just because it had this nice run higher. In terms of its overview, the technical overview, by the way, I've classified it on the daily as bull average. So you do want to be caught only when it's falling back. You only want to buy maybe after a significant reversal, just because of how volatile it's gotten at these levels compared to the typical intraday ranges that we saw pre-Trump victory. Because I think what's been happening a lot is people kind of going, okay, I want to bet on Musk, right? So okay, I can't really invest just yet in what is it, SpaceX and Starlink and what is it, or
Neuralink,
the Neuro one, Neuralink. Sorry, all those different companies that he's got. I'm not able to do that. The one play, if you will, in the stock market is really Tesla, and we've seen that move considerably higher. Now, people are going to come and go, hold on, what about valuations? What about this? What about that? Putting all that aside, though, if we are looking just at from a purely technical standpoint, yeah, it's a bull average. We are working within a slightly larger channel. Just what it means is that if it gets the first resistance, conformists are going, I'm going to go for a buy breakout strategies. But when it goes to the first support, ideally, you don't buy unless after significant reversal. What it means is let it break below 381.19 significantly, wait for it to come back, and then go with it. Now, interestingly enough, on the weekly time frame, because you've got there are the two tables there. There's you got the column for the daily, and then you got the column for the weekly. For the weekly, I've actually classified it as consolidation volatile. I know it's a bit contradictory. You go, what's going on? But essentially, conformist strategies would be breakouts, and reversals would be contrarian in that case, just because of what the technical signals are showing on the weekly time frame. Where it's not a matter of being directionless. It's a matter of you've got so much of a move beyond weekly technical levels that take a lot longer to adjust compared to daily. Daily, they adjust relatively quickly because, if you're looking at an average of, let's say, the past 2 weeks or the past month, the levels can adjust much more quickly compared to the weekly time frame. The weekly time frame, you're looking at the past, say, 30 weeks or so. So if you've had 2 or 3 crazy weeks, or let's say 4 or 5, it's just going to take more time for the weekly time frame to adjust. And that just has meant that net so far, conformist breakouts are the one that have won out over contrarian reversals. And of course, breakouts to the upside just because we've had these moves higher. So those, of course, for this week, but that's essentially what we've been seeing on Tesla. And technical boxes, by the way, all flashing green. Shouldn't come as too much of a surprise, but on the daily time frame, a lot of those technical boxes can shift relatively easily compared to the weekly. Now, in terms of sentiment, it's been a story of, like I said, big tech, they usually like to be majority buy, but we are seeing on this latest run higher, they are starting to get out. And they're still in heavy buy territory, but I want to say almost only just 65% and above. I consider that heavy buy. They're no longer in what was much heavier buy territory. So I think longs are looking to get out. Some shorts are looking at this going, I want to go ahead and start shorting at these levels just because maybe they see it's gone a little too far, a little too fast, and not based on the fundamental considerations that they're looking at. Because I know a lot of what we've been seeing is a momentum play, a get on Musk play, but some people are kind of going, if you're looking back at the numbers and going, okay, wait a minute, but as a company has the numbers, if you're not bullish or this bullish, they might be looking at a price target below this, and that's why it's understandable to see why some longs would get out and some shorts would want to initiate.
And we've got loads of new trader friends watching our show here. Just let's talk about the rings. One of my favorite things about your report, Monty, are the rings. So let's talk through. Why don't you talk through the inner ring and the outer ring and what that tells us?
Absolutely. So the outer ring on the daily market report is the sentiment as of this morning. So I input those in the morning. That's today. So when you see 66%, well, blue is percent long, red is percent trader short. So 66% of them are long as of this morning, and then 34% are short. The inner ring is as of the previous trading day. So in the case of, if today's Tuesday, that is Monday. On Monday, there were 65% long. And if you're looking at it on a Monday, if you got the daily market report on Monday, then the inner circle would be that of Friday, because it's the previous trading day, which would be Friday. So that's it. And by the way, if there's a holiday, for example, then you're skipping that. So for example, if we've got, I think Christmas is going to be on Wednesday. Was it Wednesday or Tuesday? I think it's going to be on Wednesday, for example. So that means that if you're looking at it on Thursday morning, it'll be that of Tuesday, the previous trading day, that when you can actually trade it. But that's essentially what those trading circles. That's for IG client sentiment. If you look at some of the key indices and commodities and effects, when you look at and you see, for example,
let's take a look at cable. There we are, cable.
There we go. Yeah. So IG client sentiment. There's a lot more information here because the cable is available on the COT report, and I extract from that institutional sentiment, asset managers, and leveraged funds. So that report is released every Friday. So, and the positions are as of last Tuesday. So I update every Monday, but basically the outer circle is the most recent report, so last Tuesday, and for the inner circle is for the week before that, positioning as of the Tuesday before that. So the report is on Friday, but the positioning is as of last Tuesday. And what that says is you've got your mouse over the institutional sentiment. They're a majority buy, 55 net long, I should say 55%, because it's based on lot sizes. And then they're 45% short. Not much of a change, but I think if you scroll down just one of them to USD JPY, that was the one where, no, sorry, that's Euro GBP. Yeah, you can go a bit lower, maybe a couple more lower. I think you get to USD JPY. We had a shift in institutional sentiment. They shifted from 56% net long to net short USD JPY, which means they are now net long yen. And you can see it on the chart. The green dotted line went below the black line. The black line, the solid black line, is the 50-50 line. So whenever you see a dotted line below it, it means they're now majority short. Whenever you see above it, that means they're majority buy. And you can see that both institutional sentiment as well as IG client traders, they're both majority to the sell side in USD JPY.
Nice. Love it. And there you go. There's a great overview of how to use Monty's sentiment report. Whenever I am about to put down a trade, I use both fundamentals, technicals. However, this is also really, really key, these indicators from Monty's report, because it shows me what other parts of the market, what others are thinking. Thanks so much. That's all the time we have for Monty, but very excited to have you back in the coming week. We've got tons of our viewers saying thank you so much, Monty, for talking us through that. Arich asking for a quick look for gold on the daily report. Let me just quickly, do I have time, people, just to get that quickly up? They said, oh, go on then. Here we are, Arish. Here we are. Gold's up for you. Take a handy snapshot there once the show is over. Adam Deleuze, one of our premium clients, saying that great research, Monty. Thank you. Great cursor where he thought that was his cursor. But thanks so much, Monty. I hope you have. Do we have you one more session, or are you off for your break now?
No, I think we got next week I'm in, so.
Great. We'll catch up then. I'll send you a list of things because we've got loads of questions coming through. But otherwise, trader friends, will update you when we can get the Monty report to your inboxes. Until then, we'll see you after this break.
Corporate earnings reports are quarterly reports that reveal the financial results of a public company. They include valuable information such as revenue, net income, and earnings per share. Investors can use corporate earnings reports to gain insight into a public company's performance. They help investors decide whether it's time to buy, sell, or hold on to shares. So, how do corporate earnings reports impact trading? 1. They affect market indices because indices are made up of publicly traded stocks. Index values go up or down based on stock price movements tied to company earnings news. 2. Corporate earnings reports can signal a healthy or unhealthy economy. They could influence central bank decisions on interest rates and monetary policy. 3. Unexpectedly positive or negative reports have the potential to induce volatility in the stock's price and prompt activity in the market. 4. This surge of trading activity could result in more liquidity. It becomes easier to enter and exit trades when there are more active buyers and sellers. However, increased volume can also introduce greater unpredictability and price swings. 5. Positive reports can bring in foreign investment to a country's market. Negative reports could make foreign investors less interested and reduce their involvement. 6. An earnings report has the power to sway how investors feel about a company or the market in general. How an earnings report impacts the price of a stock depends greatly on what investors expected. If earnings exceed estimates, the price tends to go up. If earnings disappoint, the price often drops. Meeting expectations is key. Even good news might sink a stock if investors hoped for better news. Likewise, a stock could jump if bad news wasn't as bad as predicted. So, how do you trade corporate earnings news? The challenge is to work out how you might react to news that will thrill or disappoint investors. Have an action plan in place for earnings that exceed expectations, or earnings that might disappoint. There is also a chance that the earnings might be exactly what the market expected, and there won't be much price movement at all. Keep in mind that the market can be unpredictable, and these changes can happen in a flash. Option strategies can allow traders to trade big price swings in either direction. Strategies involve buying both call and put options on a stock prior to the report. Call options can protect short positions from rising prices, while put options can protect long positions from falling prices. Finally, it's essential to have risk management practices in place, such as an airtight trading strategy, stop-loss orders, and portfolio diversification. Consider bird's-eye view factors like industry trends, the health of the economy, volatility, revenue growth, and trader sentiment. With preparation, agility, and risk management, you're on your way to trading corporate earnings news effectively.
Hi, I'm Sean Mearson, Senior Market Analyst at IG, and join us for our new show, Charting Essentials. That's every fortnight on IG.com, our trading platform, as well as YouTube. And that's a show where we look at everything technical analysis, hoping to help you upskill, whether you're starting out or just looking to level up. We got you covered. In each episode, we'll break down complex concepts into easy to understand lessons, provide practical tips to help you sharpen your chart reading abilities, explore powerful technical indicators and their real-world applications, as well as guide you through hands-on examples to reinforce your learning. So come, let's work on our skills. Let's get better at this. Let's accelerate that trading journey, learn to have confidence to trade, and make informed trading decisions.
Hey, welcome back to Market Measures. And for this market measure, we've asked Sahil to crunch some numbers for us to take a look at market trends that have just passed. A look at current market trends. Let's get started. Right, so Sahil has kindly asked us what our trader friends would be most interested in. And we said, how about taking a look at how we've compared in the week starting the 2nd of December compared to the long-term average, as well as different instruments like bonds, gold, euro, oil, Irish. You'll like to know that gold is there for you. Natural gas, is that Andrew McKilvey, one of Andrew McKilvey's?
Yes, it was. And Chris Beecham.
Yes.
Chris Beecham was aggrieved yesterday because he wanted to buy natural gas on Friday. After that down 8.5% move, as it had a big bounce.
Yeah, and Bitcoin as well over there. And taking a look at, of course, you can do this on the options platform versus real-time data, and it shows you the long-term average on the right-hand side and what has happened in the week of the 2nd of December, week starting the 2nd of December. So as you can see there, the weekly expected move, let's take a look. That's in terms of dollars, so plus minus $60 for Spider for the SPX, and we saw as a percentage as well plus minus 1%, and in actual fact we got pretty much bang in line, right? Plus minus 0.9%, and the actual move was plus 1%. The VIX as well, not too far off, 14.1, and correspondingly 12.8. Oh, I love a cone. So here we have it, this cone that Sahil and Dr. Data and Kai and all those good people there that crunch our numbers for us, they love cones. And this is what you can do with options and looking at data. They've given us this green cone to show us the range of that expected move, right? So expected range versus where we've actually ended. And it's not far off, really, taking a look at the dot there.
Right, then we look at this fantastic tool that I've only just learned in the last few months, the IV rank. So implied volatility rank. Where is the vol relative to its own history in the instrument? So the S&P 500, you can see, look at this, red arrows across the board. We're seeing drops in IVR, implied volatility ranks, across the board in every product. So that's really interesting to see there, and gives us a very clear message about what's been happening to vols. So major asset price move, bonds, you can see up 45 basis points, gold down 1, and yeah, much of a muchness as we saw in the first slide. This is a really interesting. So the VIX now 12.8%, 16% average this year, 17% long term. So we're really getting down. And I think yesterday we got down to 9 at one point. And Elliot Harris just saying to me in the kitchen on my nice break that Ange gave me that
you're there drinking stuff and not trading. When you give me that nice break, I'm out there going.
The nice hot
It's so nice listening to you and Luke because I can actually move on some of the what were you talking about this morning? I think it was moon peg. That's right. And big move. And Tom W asking me, what are you doing, Ange? I want to talk to you about our segment. I'm like, please talk to the hand right now. Don't talk to me right now. We can talk. Save for the show. Save for the show. So what did Elliot tell you?
So he said that when he sees the VIX get down into single figures, then that historically has been a real, you found the floor at that kind of level, and it's worth just looking at putting some kind of put option protection on. So I asked Elliot to go away and look for me something clever, something that would explode higher in value if we were to get some kind of sell-off. So he's doing that, and we shall keep you up to date on his trade of choice. So yeah, VIX very low there. Largest movers over the past week. Lululemon, I missed that actually, up 17% on numbers. Hershey, we obviously saw that takeover yesterday. Intel on the weak side, with the CEO leaving, Uber with Waymo entering Florida. And yeah, that was the biggest moves there. So as I said, up 25% Lululemon on numbers on Thursday after the close. Ulta, American Eagle had good numbers as well.
That's the apparel maker, right? Is that right?
That's right. Yeah, I thought they had bad numbers.
I thought so too. If you go back one slide, how did United Health do given the the killing? Because now they've managed to find a suspect, right? Is that right?
That's right. Yeah, that was all cleared up and he was charged yesterday.
Okay.
Yeah. So,
down 11.
right, and then just a earnings review of everything as well. We've got 46% winners, 54% losers, and the average return, as always, it always shows 0.1%. This week's upcoming earnings, Oracle had a shocker yesterday, down 8% after hours. We got GameStop after the close today. Don't know if I'll be tuning in for that one. Macy's tomorrow. And then Broadcom's the big one for me on Thursday after the close.
Yeah, someone in the gallery is going, Costco.
And Costco.
Cam, our one of our directors, loves the Costco Sizzler, I think is what he calls it. Yeah, Cam's like, he always tells me about the Costco hot dogs or something like that. That's really, really good.
Right, so that is today's market measures. Let's jump on to look at what's next, shall we, Angela?
Yeah. Hey, trader friends, there's actually a lot coming up in the coming session and week as well. I almost
What
feel,
are you looking at?
I almost feel slightly cheated because I thought like we're kind of like, we're so busy at work. Year-enders, your big fat quiz coming up.
Big fat quiz coming. I wondered where you were going to go with that.
Big fat.
Waistline.
That's very svelte. You've met him. And also the webinars that we do at the end of the year for our clients as well. But it's actually really, really busy. So first one that I'm looking at, obviously the miners and the luxury stocks that have moved quite rapidly. You were saying that you were thinking this is the real bazooka, right?
Well, in this, I changed that to it's them getting the bazooka out of the container. So the bazooka hasn't been fired yet, but we've got the...
They're dusting it off.
Yes.
Right.
It's ready to go.
Okay. Because I just think, if you short and you go long on an intraday basis, this is a great opportunity, people, because, we had obviously luxury and miners rise early on in the week after that change in tone and wording by the Chinese. But then we also had weak trade figures, right, out China, and that kicked miners like Antofagasta, Glencore, and also some of the luxury stocks.
Interesting to see the autos have held up well, though. So Mercedes up 0.5% on the day, Porsche up 70 basis points, Volkswagen best performer up 1.5%. So the mining stocks have paired their gains, but yeah, autos staying strong. Let's see the losers there, and yet the luxury goods more like the miners there. So let's have a look at how that ties in. Rolls-Royce also down 2%, 570, and what else have we got there? Yeah, JD Sports dropping back towards the £1 level, back to 103 now.
LVMH is down almost 2% there. Hermes as well, getting a bit kicked, but not as much, holding up quite well considering what's the sector's been doing. In terms of all sessions, the gainers are the ones that are linked to Bitcoin, Coinbase up, MicroStrategy also up, right? Blockchain also up. It's also
zoom in there to see those.
Yep, there we go. There we are. Is that better?
Yeah, much
we
better.
are. Yeah, and then Rivian also holding higher, all sessions there. Also taking a look at the losers for you. Oracle, because of what we saw in the last session, down more than 8.5%. NEO also down. It has to be said, NEO had a really good day the previous, when we had that change in Chinese wording in terms
Yeah, it was
of...
about 14%, wasn't it, yesterday?
Yeah, I missed that one yesterday. I was really gutted. But you know, NEO, like all the other all-session stocks relating to China, very, very volatile out there. So make sure you have your stops and limits in place. Taking also a look at Moonpig. Did you rig producer Fred's laptop earlier? I heard a yell.
Yeah, I absolutely did. I got the Moonpig website up on producers Fred's laptop and left him a nice Christmas card, which is suitable for him, perhaps not suitable for on screen. He's back in HR again, he says.
Do you want to get Moonpig?
But I did actually go across to the trading desk and I asked, I was like, look, they keep on speaking about Moonpig this morning. Can we please tell them that we don't see any trade in it and there's no point mentioning it? No, we have. We've seen about 8 trades in it this morning. So it shows you that out of 80,000 clients, 8 of them do actually trade Moonpig.
Yeah, there you go. There you go.
That's meant to be sarcasm.
Do you want to get it up? Because I've done this thing with my screen and now I can't reduce it, so I can't find
What's
my
this,
search.
Moonpig against the Russell 2000?
Moonpig.
Why are we looking at this
Moonpig.com.
again?
Is it down?
Right, what do you want to know about it?
Is it still more than 10.5% down, or is
It's
it?
exactly 10.5% because nobody trades it, therefore it isn't moving.
TeamViewer is down, also 10%. That's after it signed a deal to buy that IT firm 1E, right, for an enterprise value of $720 million. But what I am also looking out for this coming week, which I'll move into your view so you can see it, because there's a nice article written about it, especially for our clients. Bank of Canada preview, right? Interest rate expected to remain at 5%.
Right, but look, just as everybody was talking about Google earlier and this Willow chip, right? We can see that is seeing Alphabet up as best performer on the day. Sorry, that was just the price was up there, and I just wanted to highlight for everybody on the chat. That was the main thing that everybody was talking about this morning. First thing.
Septillion was the number, wasn't it? It can crunch numbers that are so.
Oh, at that speed, which is just absolutely incredible, isn't it?
Yeah.
So Gavin pointing that out right from the off. Monkey Man as well. We got Google, Alphabet up 1.7% on the day. So
it's all about the qubits. The qubits, darling. The qubits.
The qubits.
Because it's not just 1 0 1 0, but it's like they can do it something like at the same time, so it goes so
10
much faster.
septillion.
There you go, septillion.
Yeah.
So it's all about qubits as well, QUBITS, meaning that it can crunch numbers and alternate the 1 zeros. I might have got that wrong, but it just all it means is complex algorithms, maths, everything can crunch it so much faster, right? Speaking of which, we have a game.
We do.
Are you ready?
What's our game?
Our trader friends ready? Because I was watching and listening and sort of bopping to Luke and Rich as us marching or trying to jog. I'm about to head skiing soon. I feel really out of shape. And so I was trying to jog, but actually it looked like a slow hippo.
I doubt that very much, Anne.
Walking across London Bridge, feeling a bit puffed out in the slight rain. So are you ready to be my glamorous assistant?
Oh, yes.
Da, 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 da. He's very good at these. I'm not as good. So earlier today, I heard you and Luke asking about a specific Chinese online retailer.
Ah, yeah.
Yeah. And both of you are talking about how to pronounce it.
Yes. Oh, good. You're going to teach us at last, because I keep embarrassing myself with this.
Okay, are you ready? So there's no right or wrong way in the universe. My policy is as long as you get your thoughts across, you know what the position is. That's all that matters, right? But the name of this company is actually 2 characters, 2 Chinese characters, and the pinyin 2 syllables. Okay, so I'm going to draw a picture, and you're going to try and guess along with our directors.
It's great.
How to
Interactive television at its finest.
Are you ready? Are you ready, glamorous assistant?
Go on then.
Are you ready, trader friends? Okay, so you're going to show them.
Oh, I'm going to show this.
Yeah.
Okay.
I should have been a doctor. My handwriting is atrocious. Well done, Caleb. Right, so you see the picture there? She, in.
What's this one? This one here?
So in and out.
So it's she out.
She in. No, she in. She out. She in. And the two.
Perfect. I'll never forget that.
The pinyin characters
go.
mean
She in.
this is all synonyms. It's rare melody or rare tune. So you are rare melody.
That's what this means.
Yeah, a rare tune or rare melody is the synonym. I mean,
Right.
everything about Chinese characters
So
is.
why would they call it that?
It's just one of the play on words. It's like, you know, Taobao, which is the another sort of online retailer, and their USP is that you can buy everything. Like imagine Amazon on speed, but instead of buying like just your garden furniture, you can buy the hot tub, and you can buy, you know, 15, I don't know, wetsuits and it can all come.
This is everything in one place.
Yeah, so Taobao, which is the other one, that one means, it just means treasure. It just means treasure. And
Taobao.
it's like a treasure box, you know, like pirates, right? And so it's just a play on words, a play on sounds. And so
Everybody let us know if there are any other Chinese phrases that you would like to hear the sounds like for your Christmas games.
2 syllables. Movie. And we're being told by our directors that they can't charge for overtime again. But we love the show so much, we want to stay on, you see.
There we go. Source Brand saying, must say I learned so much in the morning. Thank you all.
There you go.
But I have butchered that many a time. She
in.
No, I know.
So Adobe as well, fourth quarter on Wednesday, and of course we've also got Costco Broadcom, and we're being told 1 minute over. So unless we want to get dragged out by the ears, we're gonna have to say goodbye.
Wonderful day. Thank
She
you,
out.
everybody. Quick. She out.
She out.
He out. She out. And you're all out as well. A very good day to you all. See you tomorrow.
We got a lot to talk about this week, though. Full 5 days of trading coming up ahead of us. Dylan, let's start with you. It's a wild week. It's one of those weeks where a whole decade has happened. Is this the market finally today coming to terms with the fact that maybe, just maybe, some risk has been underappreciated, geopolitically speaking, for the past few weeks?
Only if you think of a market that more or less has got stopped going up to a record every day. I mean, it's not like there's not some major markdown in prices. I mean, it's sort of like the burden of expectations for even the highest performing index or security price can only, reach such a certain level where it's going to disappoint. But I think that to look at the fact that it has gone down a little, or even gone down 2 of the last 3 days, again, modest declines, is meaningless. I mean, I think even Ilya, who would be delighted to be, proven right on some of his more pessimistic points of view, not that he's even a pessimist, but Ilya, are you winding into some wild short position here? I can't imagine.
Not at all. No.
Yeah.
No. I mean, I don't think you can. I mean, I think if you look at the Russell, that one makes sense. There was a double top there. It's pulled back. It's held the bounds of the range breakdown on Friday and today. It had opportunities to undo that breakdown. It tried and failed. There you can see it. You look at the S&P, you look at the NASDAQ, and as we were just saying on last call, and as Chris and I said on Futures Power Hour earlier, it's that former high, that November 11 high that we see on the screen here. That's the magic line in the sand for me. You give me a close under that, and okay, we've set a lower low, something's different. But as and until, this is a stair step higher. And as skeptical as I am of not the impetus for the rally, but the price level given the ongoing fresh fodder feeding this, I think the price level is high and the fodder has been spent a while ago. So it would make sense for there to be a correction. But that's all speculative and that's all hypothetical until it isn't. And there's no evidence that it is at this point. You need to get back under that former high to tell you there's a lower low and something's rolling over. You need a sign of capitulation. That's just not here.
Why today of all days producing this kind of negative move in risk assets? It's not contained just to stocks. Of course, you can just see a little bit lower there in the left panel on the screen. Rough day for crypto as well. Like the risk sensitive aspects of this particular segment of the market are getting hit hard. That's a divergence, Ilya, from what you see in the currency space. In the currency space, the Japanese yen is the worst performer. So every single yen cross, if it's CAD yen, Euro yen, Pound yen, Aussie yen, dollar yen, they're all up across the board, which is usually a sign of risk on. And the leader in that parade or that procession is Aussie yen, of course, which is up huge today, up by about 1.7%.
Yeah.
So square that circle with me. The stock
Easily
market,
done, sir. Easily done.
Pray tell.
Yields. Just look at yields. Stock markets don't like higher yields. And what you see here is a response to higher yields. Probably the most significant rise in yields we've had in weeks. Now, I don't think it changes the trend, but it is a significant rise in yields. And you're seeing that significant rise in yields echo in the dollar's performance against the yen. You're seeing a sogginess in other major currencies against the dollar. So the euro is down a little. The pound is basically flat. It's not having a strong response. The Aussie is back on the back foot and starting to retreat off its earlier highs, which I'm sure we'll talk about, were mostly China induced. But those gains starting to get eroded here, and the breakout there going away by the close, the dollar reasserting itself. Crude oil higher, gold higher. All of this seems to be, interestingly, a response to what's happened in Damascus over the weekend. Because, and the start seems to be the rise in crude oil. Because what you've seen here over the course of the day, we mentioned this earlier, it's kind of strange. You had gold, yields, and crude oil going up at the same time. If yields are going up, it's weird that gold is going up at the same time. It yields nothing. They typically move inversely of each other. Higher yields make gold less attractive, not more. So it's curious that that's going on. But if you consider that the reason yields are going up is because oil has gone up, and that's where this begins, and oil is reacting perhaps to essentially no knowledge of what's going to happen next. I mean, obviously, I don't think anybody's shedding tears for the butcher of Damascus being removed from his post and sent packing to Moscow. But we do have now a very significant knock into the sort of Russia-Iran regional infrastructure. Obviously, Hamas has been significantly demolished. Hezbollah has been hit hard enough that they went begging for a ceasefire. Another major piece in the Russia-Iran regional influence architecture has fallen away in Syria. This is a big development. It's not necessarily a big development near term. If you look, oil hasn't broken its range. Gold hasn't broken its range. But for the one day of of price action that you see here. If you begin with oil, then higher oil leads you to higher yields. Higher yields lead you to weaker stocks. Gold is up as confirmation to give you a sense of geopolitical uncertainty. Yen is getting killed, and the dollar is, let us say, reclaiming a bit of lost ground, or at least finding a lifeline, even against European currencies.
Gold story seems to extend beyond the Middle East today. China's stimulus announcement over the weekend, overnight, where they also changed their monetary policy stance from prudent to, we'll call it a little bit looser. But it's the first time they've changed the language around their official monetary policy stance in 14 years. Likewise, after we get that announcement, we see that China has officially announced that they've resumed their gold buying as of November. What day in November, they don't tell us, but I would imagine it might have been around the 14th when gold stopped its fall for the rest of the month. Dylan, this was such a powerful narrative back in the spring and going into the summer. June 7th, when gold prices fell back, it plunged us right back down towards 2350. Although that was really the end of the road for gold's fall. Do you think that China stepping back into the market is going to have the same type of, reverse reaction here, where this is the end of the story? Or, as people who have been on the long side of metals at various points this year, you famously cornering the silver market, do you think that this is the good news that bulls have been waiting for, maybe that shakes us out of this sideways stupor?
I don't know. I mean, I find the whole thing fascinating. I mean, I guess it's sort of obviously very much worthy of discussion, but I hate to answer your question with a stack of questions. But unlike silver, which trades in some ways relative to supply and demand in some industrial components, at least in my opinion, gold obviously has sort of the mystery component of central bank buying that's only reported well after the fact and at the time is sort of speculative. And then you have the crypto component as a recent arrival to the gold price. And so I don't even know what makes gold, like I can talk about what drives the silver price or what drives Tesla's price or the S&P's price or whatever. I don't know what is gold's price? Is it a referendum on inflation? Is it a referendum on risk? Is it a referendum on currency alternative of some kind? Is it a referendum on what is it? What is gold price even? What do we think it's even? What risk is it pricing? What supply and demand is it pricing?
To me, gold is basically a foil for the dollar as a kind of alternative to fiat currency. It is also a foil for interest rates because it yields nothing. So,
but isn't that what Bitcoin is now? I mean, at least in the first instance.
I think Bitcoin enthusiasts would like to say that. I think they would like to say that what Bitcoin is. And by the way, we heard this from Jay Powell when he spoke at the DealBook Summit last week, which sort of lends credence to the perspective. He said, well, look at Bitcoin is basically like gold. It is a speculative asset that reflects the same speculative give and take that gold reflects. Speculation about the attraction of fiat and speculation about the direction of rates. And that if rates look loose and fiat looks weak, value storing alternatives are interesting, and gold and Bitcoin basically occupy the same space. I am not quite sold on Bitcoin as that, but that the market treats it as that enough of the time.
But Chris seems to be asking me my opinion of gold, and I'm throwing the question back to gold specific. I would say I could better explain what I think Bitcoin is pricing, meaning of the speculative fever and FOMO and techno utopia, techno utopianism and whatever. Or I could say why silver is trading. I can't explain why gold is priced wherever it is. Even oil is a much easier handle for me. I don't know why gold is where it is. You're saying it's the dollar. It's a dollar. If the dollar is strong, the gold is weaker.
I think the difference between sort of those kind of more usual catalysts for gold is you've had periods of weirdness where those things don't work. One of them was China's aggressive accumulation of reserves, mainly last year, where they were growing their gold reserves at a very rapid speed, and gold really was behaving for no rhyme or reason until you looked at Chinese gold reserve numbers. Gold also has this weird, and I would argue undeserved, thing that it does where when there's geopolitical risk somewhere, markets reflexively go to gold. I don't think there's any good reason or logic why that is. I think it's mostly legacy, but it does seem to happen episodically for a day or two when guns go off.
I think today is just simply about the weak dollar and the China buying story, right? We're getting another wave of the whole China is stimulating the market. We see it here in FXI up 8.22% today, obviously taking back a big share of the losses that were in place after shares peaked out back in early October, perhaps about half the losses, back to an area where we peaked out right after the election, interestingly enough. Ilya, you and I seem to be at a little bit of a, I say, disagreement here about the sincerity of China's stimulus announcement, but it also seems like we're very much on the same page that this isn't enough yet. But
they got to do something.
They still got to do something, but at least within the announcement that they've made, there is enough lip service being paid to the notion that they realize consumption needs to go up in order for the recovery to gain steam. Whether or not the PBOC is the institution that's equipped to make those changes or spur that type of shift in consumption is one thing to be seen, of course, and we certainly don't think it is. But at least policymakers are now talking about how the problem is a lack of demand in the economy, not the supply that they've clearly flooded the zone with.
Yeah, I mean, this is not new. It's been pretty clear that China has been talking about this. I mean, notice the rally from September. Why was that rally there? Because the Politburo back then came out and said, we need a more generous fiscal stance, and that's coming. And then they didn't do it. And then didn't talk about it thereafter. There was a big, loud meeting of party officialdom. They had a big CPC Congress where they were supposed to unveil these things. The Ministry of Finance was supposed to make a big announcement thereafter. None of it materialized. Instead, they had a bunch more tinkering at the margins type of measures about improving the finances of regional governments to basically let them roll over debt so that they can borrow and spend more. There seems to be a kind of allergy in Beijing to big national fiscal spending. They seem to only just want to give inducements via monetary measures or via refinancing for regional governments or all of these things, giving money to regulators and the sovereign wealth fund to go buy stocks, all this stuff. And if you look at the way that U.S. markets have taken this on, I mean, obviously we have a big jump in FXI here. This is a U.S. dollar-based ETF. If you look at what Chinese markets themselves did overnight, they barely moved. In fact, the onshore mainland stock index was down a bit. Hong Kong rallied, but it didn't get out of its range or go very far at all. This seems to be more like optimism outside of China about maybe this is something. Now, in fairness, a lot of the bad news out of China is already a known. And so with that, you probably, until you have the tariffs show up and new variables emerge, you probably have some room for the markets to give Beijing the benefit of the doubt on saying, look, we're finally ready to do something. And that's probably why you get the Aussie rallying on this. And as long as the trade numbers that come out later this week are not horribly worse than expected, which seems unlikely, then you probably continue to get the benefit of the doubt. But that doesn't change the fact that structurally, China hasn't done anything, having promised stuff before. And their monetary stuff just plainly isn't working.
We'll see.
But I mean, how does what China is or isn't doing in terms of their economic policy or stimulation or structure, or whatever you want to call it, how is that relevant to whether, are you suggesting?
Their economy is in shambles.
Right, but
falling apart.
What we're talking about, gold, no gold here. Does that directly, does their economy in shambles make them a gold buyer, non-buyer? Believe them, don't believe them? Do I care? Do I don't?
As far as gold, I'm not sure it makes much of a difference. I don't think that there is anybody in China saying, you know what, we can't be spending all this money to buy gold because we need it for fiscal stimulus. I don't think it's the same pot. I think it's more like a willingness to do fiscal stimulus, which Xi Jinping seems ideologically opposed to. He doesn't seem to want to do that kind of a thing because he doesn't want the economy to become reliant on government outlays from the center. He essentially, the way that he's phrased it is, he doesn't want high growth, he wants high quality growth. That is to say, self-sustaining. And so it's unclear whether there is an understanding to this point in China that what you need is to replace demand. Because for 6 consecutive quarters now, China has had no demand. They've been in economy-wide deflation for a year and a half. That's abysmal. So they need to do something. It's a huge threat to global growth, and it's a huge threat to stock markets if ever the U.S. were to misstep. And there is no perpetual motion machine. Eventually, the U.S. will misstep. So the threat here is the global economy is operating with no plan B to U.S. economic growth at all. U.S. is shrinking, or Eurozone is shrinking. China is nowhere. They've been idling for years, and the U.S. is booming. If the U.S. were to ever not be booming, then what is going to power global growth? The three of them together are 58% of global GDP before we account for all the economies that need those three to grow to have export demand. So it's actually even more than that. That's the issue.
The news out of China that interests me most today is that they're introducing new antitrust investigations into NVIDIA, which seems to me to be a very funny reason for a stock to sell off. Why do I bring that up? For NVIDIA in particular, if people want to go back to August 2nd, that's a day here on our chart. Market gaps open lower, of course. That's the Friday. Non-farm payrolls report, slightly weaker than anticipated. But that's when we hear that the Justice Department is investigating complaints against NVIDIA. Now, that reaction lasted a full, we'll call it more than 24 hours because technically it's a weekend, but in market time it's not. And NVIDIA bottomed the next day and hasn't looked back since then. I don't know, guys. If China is stepping up antitrust probes into NVIDIA, it feels like it's more about the tit for tat of the forthcoming trade war than anything else. The Biden administration just, of course, levied new tariffs onto China. China responded by banning shipments of rare earth metals to the United States. Now we have this coming out. Dylan, should we take this seriously as a threat to the AI superglide story of 2024 continuing into 2025?
I can't imagine how you could possibly. I just don't. There's what on earth is going to. The only thing that's going to derail the AI superglide is going to be the inability to actually manifest value from the use of AI. But again, which I think is a real possibility, certainly relative to time frame expectations. But I also Bezos said it, I think, the best last week when he was talking in New York, and he said, listen, AI is a universal horizontal factor like electricity. So everything uses electricity.
Mm-hmm.
Everything will use AI. And so is electricity going to be derailed because of a political policy or a trade policy? No.
This is the whole thing.
If you're
right?
Germany,
Like,
yes.
Telecoms were not derailed by the dot-com bust. Nevertheless, we had one. Railroads were not derailed. Ha ha ha. That was not intended, but I'll take it. By a giant market sell-off in the initial phase of over speculation about booming railroads and everything is getting interconnected and it's a whole new world and steam engines and yada yada yada. So sure, of course. I mean, I agree. The question is, as ever, of price. Is this the correct level now? And there's no confirmation at this point that it's the market's realization that it's not, but the structure in NVIDIA here is starting to look a little head and shoulders-ish, which is a top. Now, if this were to turn, NASDAQ would turn because it's such a huge component. And if NASDAQ turns, lots of things turn because that's such a huge component. So does the AI narrative need to be wrong for that to happen? Not at all. Just needs to hit a speculative road bump. So could it happen? Of course. Is it happening confirmed now? No.
Top performing sectors today in this market, to no one's surprise, those are the ones related to the metals. Gold miners, junior gold miners, they're your top two performers. XME, likewise, the metals and miners, 0.79% higher. Otherwise, energy, XOP up by 0.95%, OIH, oil services up by 0.71%. The only non-commodity positive group on the day was home builders, ITB. You also have XHB, home builders, 0.71% higher there. You can swing around to biotech or healthcare, but real estate and healthcare are the only non-commodity names that are up on the day. Is there a signal amidst this noise? Or is this just a noisy Monday where we have a little bit of trading volume back in these markets, 1.27 million contracts traded in ESZ4, Ilya?
I mean, when you look at what you have here, again, it seems to be that a lot of this is tied together with a response to geopolitics over the weekend, because it does all seem to kind of stem from everybody wakes up and goes, China stimulus, but also Syria has fallen. And you see that mix in the dollar most acutely and in the gyrations of the Aussie dollar, which first goes sharply higher on the China news, then ultimately retreats as yields inspire the dollar in the latter half of the day as the U.S. comes online, because the story starts being oil, yields, stocks, currencies. And so in that sequence. And so what you find here, I think, is something that's going to probably unravel come tomorrow, because what you're going to start to really focus on is immediate event risk, because nobody knows what Syria means, and it's unlikely that anybody's going to know what Syria means for weeks and months on end. We have no idea if this is going to be, let's say, Libya, or if this is going to be Egypt, to look at the Arab Spring experience, or if this is going to be Tunisia, to look at the Arab Spring experience in a very different way. So who knows what this is? The initial comments out of HTS, the lead rebel group, and their leader Jelani seem to be very encouraging. They're saying officials don't go anywhere. We're not purging anybody. We're not gonna hamstring any minorities. We're not going to impose any kind of Islamist dictums on anybody. Just hang tight. We're going to have a unity government. The prime minister remains. The police and other officials were encouraged to stay on and do their job. So maybe this is encouraging. Who knows? But the episodic response is probably short-lived, and CPI's on Wednesday. We're going to get back to thinking about that tomorrow, and markets are going to swing back.
I have a much lower standard. Like maybe I have a higher standard of expectations or a lower bar here for these for HCS. Which, quite frankly, last week when this is happening, I'm like, is this like a Korean Is this like a K-pop group that's touring in the Middle East? HCS, and I don't know. This guy's ex-ISIS. Like, why should we expect anything positive?
Ex-Al-Qaeda.
Oh, sorry, ex-Al-Qaeda. Why should we be expecting anything other than what's been, Syrian civil war is part of the reason
because
why
the
Europe
people that made the Good Friday
today.
Agreement in Ireland were also former IRA. You don't make.
I mean,
you don't
I don't know.
You don't make peace in these kinds of situations without some dirt on your hands.
I don't see how Syria is not the next Libya.
It could be. It could totally be.
Or Iraq,
I mean, don't
right?
forget, could be. Isn't that? I feel like that's the most likely case.
Could be.
Just a murderous.
But the things that were happening in Libya and the things that are already on the ground in Syria are different. You didn't have the kind of thing in Libya where you had one group and it was leading and it was galvanizing everyone. And by the way, I'm not saying that I'm optimistic. I'm saying we just don't know. Because here you have a clear leadership. But already, by the way, to your point, some of the Turkey-backed groups versus some of the others are starting to see some friction, and some of the unity is starting to maybe come apart. We're going to have to see. I think the bottom line is nobody's going to know for weeks.
And I just think the bigger question is, it's like, why, from a humanitarian perspective, how can you not be concerned constantly? But from a financial markets perspective, tell me why I care.
Because this means the Qatar Turkey gas pipeline can get built. That's why we should care.
Right. So, what? Energy gets cheaper.
I would think so in that part of the world, flowing from Europe. And Turkey's a major conduit for energy into Europe now.
I agree.
Yeah.
So like if Turkey, Erdogan is, he's on my list of leaders who I wish would ban me personally from his country. That said, Erdogan's played his cards right here.
He may have already. All the things we've said about the lira over the years. They have a law against that.
But he's
made it brilliant long strategy here where now even further now in power, or at least has a lot more leverage over Europe. Right? Oh, there's now the Syrian crisis. I would like some better trade access to the European Union, lest we have more Syrian, refugees spill over the border. Or more importantly, we want to get this gas project built. You guys want to connect your pipes to ours? Like, let's work together here. So there are long-term implications for Europe's energy security that Turkey can leverage in the context of the Russia-Ukraine war. But nevertheless, I think that what a turn of events. Now, does it reduce the risk in the region? I mean, maybe Iran gets a little bit more desperate, but they are certainly reeling.
Well, they're running out of levers here.
If the past year has been defined by an environment where geopolitical risk was about which IRGC tentacle would ultimately flare up, if it was Hezbollah or Hamas or someone in Yemen, and that causing problems for a variety of markets in the futures over the past year or so, we seem to have come onto the other side of that. I mean, oil prices today, despite their bounce, IVR Inc. is 16.6. The low for the IVR today was negative 1.6, right? I mean, this is the lowest volatility that we have literally seen over the past, we're talking about over the past 52 weeks. When the IVR goes negative here on the platform, today even negative 1.6, it means volatility was 1.6% below the lowest point it had been over the past 52 weeks at one point during the day. So this is a dead market right now. It gets a little bit of a lift. Maybe it's due to the China demand story that could be coming back in. They are the world's second largest economy after all. But this is not a, this is not a market today that's moving on geopolitical risk emanating out of Syria, so to speak. And if it is, and people really think it is, I'm not of that mindset. But if I did think it was, I would be fading the hell out of this rally.
Well, no, I think it is. I just don't think it's going to last longer than a day.
There's a lot of time to tell here. Syria obviously is not a really significant cog in our export markets. I don't think S&P 500 companies derive that much of their revenue from Syria. I looked in the top 25 countries. I didn't see their name there. I don't think anyone's going to be surprised by that whatsoever. Whether or not this is a lasting story is well, we're going to see how this plays out. But as we've learned from Iraq and from Libya and Tunisia in recent years, odds are this could go sideways. Guys,
I mean, odds are. I mean, I'd like tell me how it doesn't go. I would let. I mean, not crying on it, but like.
No, seriously though, that's kind of the burden of proof is on the people who think this is going to work out well, given what we've seen in recent history.
Assume this is going to be a hellhole, murderous hellhole for the next decade, like Libya.
How is Libya negatively impacted financial markets?
That's the easiest call to make.
And so then the question is,
and it would be difficult for it to not be there.
Right. So then Libya became a murderous hellhole and still is.
Yes.
And exacerbated the Southern European immigration problem, which brought in Giorgia Meloni, which weakened Sanchez, which weakened Merkel, and sort of strengthened Le Pen, strengthened the conservative sort of strain of European leader, and weakened the liberal strain of European leader.
Yes.
The number one issue with Syria, other than for Syrians, which is it's a murderous hellhole, is more illegal immigrants in Europe.
They just may not be let in this time.
Right. But, let in, not let in, they still come. It's like, they're not, it's, I guess to game this out, the most likely thing that happens is a rise in conservatism in European politics in rejection of an additional feeder territory of immigrants.
Well, and of course, Syrians have been coming for a long time.
A murderous hellhole.
Because the Syrian civil war has been ongoing for a while. These rebels have been holding territory near Idlib for years. I mean, that was sort of their stage of operations. They've been holding a piece of Syria. So, yes, I mean, that's certainly the path of least resistance. If Syria is going to continue to be the hellhole that it's been, and if it's Libya ultimately, which is essentially a failed state and chaos, then yeah, absolutely.
Now the other version of our little future story is masterstroke by Israel going back to the Iraq War, tipping over one domino after the next.
Going back to the Iraq War, like 1983 Iraq-Iran War. Like 80s? Which Iraq war?
Yeah, 03. I'll take you back to George W. Bush.
Because I know that they bombed an Iraqi nuclear reactor, the Osirak reactor, back in the 80s. Yeah. So that's.
And I'm not gonna reject that, but when I say what I'm saying, I'm like, okay, they tipped Iraq, they tipped Libya, they tipped Sudan. They're basically in the process of eliminating Palestine. They've effectively neutralized Hamas and Hezbollah, or certainly diminished massively, and sort of secured, if you want to call it that, southern Lebanon, really only leaving Iran as
and Iran is really the force that they're fighting by proxy.
Right. Let's say we go, that's good. But I'm just so now Israel's safer and more secure than it has ever been.
Which is really interesting because now if what this inspires is ongoing peace between Israel and the Arab states, as happened under the last Trump administration, or at least was formalized. Israel, of course, has had quiet peace and mutual interest in containing Iran with Gulf Arab states for decades, but it was formalized, as it were. If this leads now to a peace deal with Saudi, and if there is a grand bargain to be had here because Iran is particularly weak, having lost Hamas and Hezbollah and now Syria and the Houthis on the back foot, this could be a significant regional realignment, especially if Israel and Turkey find a way back to be friends as they've been historically. So you get there, and now you have an interesting situation.
How is that? But so let's say you get the most secure Israel's ever been. How does that affect the financial markets?
It gives you much cheaper oil.
Mm-hmm.
It gives you much cheaper oil. And if Iran were to buckle under all of the different angles from which it is being squeezed. It is being squeezed from the Turkey side. It is being squeezed from the Saudi side. It is being squeezed from the Israeli side. And Saudi and the Israeli side are increasingly allies. In some cases, overtly. The Saudi kind of sphere of influence of Gulf Arab states already have peace and diplomatic relations with Israel, as does Egypt, as does Jordan. When you get formal relations with Saudi, which the Trump administration is going to obviously push for very hard, the Abraham Accords was one of their major wins on foreign policy. They're going to very much attempt to build that. If you actually get Iran to change its stripes over time here, if the pressure is way too hard here, especially with the Trump administration probably dialing up sanctions, or at least sanctions enforcement. Biden administration was very lax on sanctions enforcement. Mm-hmm. If you get all of these pieces together and you actually get Iran to turn and those sanctions go away and that supply comes out, game changer.
I don't know if the Ayatollah is going to do much of anything right now that's constructive.
Not right now.
It kind of begs the question that we're talking about crude oil here, and this thought's been bouncing around my mind the last few minutes. We're heading into a 2025 and into a new administration that's, I dare to say, it's not really that behind the green energy boom. We have seen, obviously, a significant push higher in renewable energy stocks in recent years, predicated on a lot of these government subsidies, tax incentives, what have you. But under a Trump administration, they could go away. Dylan, from your view in Europe, obviously, Europe has a very different view of climate change, of this climate responsibility than, American corporations do right now. I think about some of the biggest companies in the world that operate in this clean energy world, like Next Era here, ticker NEE. We could go over to something like Brookfield Renewable Partners, which is BEP, for solar, of course, which everyone remembers Solar City, but it's not the same company. SEDG, Solar Edge Technologies, and Clearway Energy. All these companies, they're not exactly going gangbusters here post-election. A lot of sideways chop to lower, if any, resolution at all. Should we be thinking about thematic trades like long fossil fuels, long legacy fuels over green energy during the Trump era, or is that too simplistic of an investing view heading into next year and beyond?
Yeah, I think that Trump is so unpredictable, and what he says has so little meaning, and at the same time is so insightful. It's sort of a very complicated situation because obviously he's going to be as liberal as possible with fossil fuels, but he's also chosen the single most successful anti-fossil fuel entrepreneur in the history of mankind as his first buddy. And so, how are you going to make a call, between, the Department of the Interior that's long fossil fuels and his first buddy on the big airplane, who's blathering on about the power of couple of hectares of Arizona give you enough electricity to power the whole earth, or all this stuff. So my point is, I would be hesitant to express a macro opinion. Although I find it interesting, like if you're long peace in the Middle East because of the Syria collapse and because of the Israeli scorched earth, and you're also long fossil fuels because marginally, whatever happens with green energy, Trump is still going to be fossil fuel friendly, maybe a short oil position over the course of, like, a longer dated short oil position becomes interesting as a commodity price. The war in Ukraine is going to stop. The peace in the Middle East is closer than ever. And drill baby drill is in the White House. And oil's going to break 50. I could make a case for that.
I heard I forget who it was today on Bloomberg Radio. They were making a case for oil. For gas prices right now nationwide are bouncing between like 325 and 350, which when you look to the futures market, not a surprise there. RB futures at 194.5. Typically there's 75 cents boost. Current oil prices from where they were a month ago. Today is the 9th, so we go back to the 8th, the final closing day, 199. So yeah, it's actually there's a little bit more there, about $1 premium. But the point is, they said that their forecast for 2025 is for the average gas price year round to sit closer to 250 than 350 a barrel. We know oil companies aren't in the business of giving this stuff away for free, and that means there's going to be a margin that they are able to charge on top of the oil that they're pumping out of the ground, refining, transporting, guarding, yada, 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 everything that goes into a price. But if we get down to 250 a barrel nationwide on average, that means gasoline futures are going to be dropping fairly considerably. That probably means that oil futures have a ways to go. That could be looking at a 5 handle, Dylan. You just alluded to seeing $50 a barrel here. What makes you think that? Is that just supply, OPEC being cowardly?
I mean, it's what I just said. It's sort of like, look where we are. Lay in everything you just described. You lay in forecast at 250 a barrel. Lay in Syria. The Ukraine war is going to end next year. Lay in Russia's pulling out of Syria. Lay in, drill any pile of oil you want in America. Get me into some 55s, even 60. The question is, you're just playing a game of madman's delight with the calendar. God help you.
Well, you need enough duration to do something like that. One of the things that rolls around in the back of my mind about some of these green energy stocks as I'm thinking about 2025, and I'm going to take some money and put some thematic basket trades in that I just kind of hold for the whole year, or at least assess at the halfway mark. And oil prices going down actually hurts the green energy companies even more, right? Because on a cost competitiveness basis, even if the cost of renewable energy is going down over time, if the incentives are taken away, then that's just that's basically you're adding up another price level there. But more importantly, if oil prices are going down, then the incentive to transition is diminished, at least in the short term. And so when you're facing the prospect of all these tariffs, I don't think NVIDIA and this antitrust investigation in China is really about NVIDIA. It's really more about the Trump administration and letting them know, by the way, your companies rely on us for business too. So let's make sure that we slow our roll before we get into a tit for tat here, because we can hurt you just as much as you think that you can hurt us.
Yeah, I've got a gun too.
Right.
And I'll use my gun too.
Exactly. There's a signaling impact here. So if we are heading into a world where the Trump administration is, promoting drill baby drill, which that means we're going to have to expand capacity here in the U.S., the cost competitiveness for green energy in a world without significant subsidies goes down. And while that's bad for companies like NEE, to me is a really interesting one. It's a fairly large company, not nothing, 9.16 million shares traded today. It's been slowly losing altitude here. And I've been watching it the past few weeks. and then haven't really done anything with it. But some of the price action recently, as we look into next year, right? Like this recent move, the pivot that we have in October, right? Kind of then becoming resistance here at the end of November, and now we're rolling over again. It feels like a market that's really in a state of decline right now. And so while the energy companies themselves, we can think about the XLEs of the world, which I have in my personal account, I've held for a long time, several years now, and haven't really given anything up. You think about XLE being able to weather the storm, right? Their cost basis for pulling oil out of the ground in the US is going down right now. The break evens in the Permian Basin are going down right now for oil companies. When Chevron last week announced that they were reducing investment into the Permian Basin, and a lot of people are saying, oh, this is really bullish for oil. It's like, no, they're reducing investment because they can get the same yield from their operations without having to need to spend all that additional money. And they're kind of reaching the levels that they're looking for in terms of production from these wells. So once you're at your capacity for production from a given well, there's no reason to continue and invest in capital expenditures around it. It's a sign of how cost effective these operations have become. So they can weather a storm, right? XLE would suffer, but without the subsidies that are provided to the clean energy companies in the midst of a tariff war, you probably have a lot more downside exposure right now. So I'm thinking about NEE, CWEN, we talked about SEDG, there's First Solar, of course. Who knows? Maybe a military coup in South Korea disrupts some of these supplies as well, Ilya.
Take a look at ICLN. So this is one that I've been looking at. This is the Clean Energy ETF. By the way, if you look at today's price action, you'll notice the spike higher on the daily chart, and that's sort of telling you that story of crude oil spiked today, and sort of rhymes with that. But if you look at the weekly chart, as you had going here a moment ago, you had a major break of a long range with the election results. If you look at where that long candle is, you can see that's early November. That's the drill baby drill election right there. You'll notice it hasn't had any legs to continue to bounce. It's just digesting sideways. I have a little bit of put exposure here. It's very cheap. So if you wanted to look for a big leg down, it's certainly been lower than this, and there's been a major breakdown. So if you wanted to buy some puts that cost next to nothing to take a punt on this story, this is one vehicle.
Yeah, during Trump's first term, which will just date to the start of the election in 2016 onwards, at least as it pertains to the market pricing it in, ICLN hits a low just below $8. And while it makes advances over the next few years where it ultimately trades back up to 10, it underperforms the broader market along the way. And there are times when even as the broader market is rallying, like when you get to the lows in December 2018, ICLN is right back on the lows. So this was up until late 2019 when everything started going up again, right?
Yeah.
This is something that underperforms the broader market structurally. Ultimately, it was hurt by the China trade war when that comes into play. We can see from, we'll call it 2019, mid 2019 onwards, there's a period where the thing just goes sideways while the rest of the market is, starting to make an advance and turn to the upside.
Yep.
The point here I'm getting at is that if there's a place where we see any clean energy stocks outperform in the short term, it probably sets you up on a path where you can fade that rally. And I bring that up because on a day like today, Solar Edge Technologies is up by 11.1%. It has a 45.1 IVR. It's in the throes of a more considerable downtrend here, right? We can see that there's some pretty interesting resistance coming up. I don't have anything on right now, but in thinking about a possible trade opportunity here, looking at a short call vertical that may be dated closer to around 20 or so, and we need to, you're a little too far away from me there. Let's go to you, strike width. There we are. Okay. We could be thinking about trades like this going into next year that give you something in the neighborhood of like a 70% probability of profit. You might have to go $2.50 wide, $5 wide to get in there, but you're talking about risking 1 to make 4, 1 to make 3. And in a thematically bearish market, those are swipes that you have to take. So rallies in clean energy for me going into next year, any of those names listed above, any of the constituents or holdings in ICLN, those will be little targets for me to take shots at for 2025. Guys, as the week goes on here, I have a few things for us to talk about. Tomorrow, we're going to discuss here on Overtime the top 5 performing non-US stock markets for 2024 and the worst 5 performing stock markets in 2024, and whether or not we think that they'll outperform or underperform in 2025. There's some interesting names on the list. Of course, China has switched places back and forth between both sides in recent months, but a name like India, for example, has been sitting atop the list for some time. Will Germany continue their outperformance despite Europe's lack of growth? I mean, there's a lot to discuss here, and maybe give us some international flavor as we think about the new year and get away from just the US dollar denominated markets and US equities, which, you know, we're not going to leave them behind, but we have to think about other worlds as well. So for that, this has been the Monday episode of Overtime. We are now out of time here. We'll be back tomorrow, same time, same place, right after last call, 4 p.m. Eastern, 3 Central. So for Ilya Spivak in San Francisco, Dylan Radigan in Milan, I've been Chris Vecchio in New York. See you all in about 23 hours time. Until then, good luck trading. Up next, though, there's more Tasty Live, starting with Macro Money and Ilya Spivak up next after the break.
See you there, everybody. Global interest rates are on the move. In fact, they are on the move in the world's top 3 economies. Will the markets care, though? That's what we're going to ask ourselves today. This is Macro Money. I'm Ilya Spivak, head of global macro here at Tasty Live. And we're going to look at the big inflection points up ahead this week. We face what would be a very active week by any other measure. But of course, we are here in the second week of December, where liquidity is already on the wane as the holidays approach, and participation is relatively modest. Witness, if you will, the relatively muted responses to an attempted coup in South Korea, the toppling of the government in Syria, and the unraveling of the administration in France. The markets seem relatively blasé about the whole lot. But this week, it is the cost of money, the most fundamental of all trading and investment considerations, that is going to be on the menu for consideration. And so it is here where we might get a bit of a crescendo on what has been a very action-packed year up to this point. And we'll start the conversation with a look at what the markets did last week, and then consider what those key points are. As we can see here, kind of a quiet week last week, but for the NASDAQ. The S&P manages an overall rise for U.S. equities of 0.8%. A little bit of a wiggle lower on bond yields as the correction continues for a third consecutive week. We, of course, will touch on what all of this follows from, but needless to say, if you've been watching markets since September, you know that there's been a massive repricing for reflation after the Fed's dovish outing at that time, and that's seen a powerful rally in the dollar, a powerful increase in yields, and over the past 3 weeks, all of that has been redistributing a little bit as that story seemed to run out of speculative fodder. Yields managed to continue down that way, albeit modestly. 10-year down 0.6%, the 2-year down a little bit more, 1.4%. Crude oil and gold basically do nothing. They wiggle within familiar ranges, but the moves ultimately don't take us very far at all. In fact, as we get news over the weekend here now that the Bashar al-Assad regime in Syria has fallen apart, and the country's being taken over by rival forces, we get a little bit of a pop in crude, we get a little bit of a pop in gold, which take us to the tops of the ranges that we visited the lower boundaries of last week. So we have a little bit of back and forth, but none of this seems to be a trend-defining sort of thing either way. The dollar basically standstill last week. Euro down 0.2%, the yen down 0.3% after sizable gains the prior week. So not much doing there last week. And we'll look at the dollar against the Australian counterpart shortly as we discuss China. And Bitcoin up 4.1%, relatively modest uptick in Bitcoin terms. But no big story there, it would seem, other than the selection by the incoming Trump administration of a crypto favorable sort of nominee to lead the SEC. So we have here a relatively modest week for price action last week, but all the reason to expect that maybe that sort of low gets shaken loose this week is we start getting some big U.S. economic data. Now, last week was not starved for it either. To be frank, we had a speech from Fed Chair Jerome Powell. We had, of course, the U.S. jobs report. So there were opportunities for things to make moves. They just opted not to have immediate follow through, and that'll be what we try to divine for this week. Can we actually get these markets to go in a direction? And we start with U.S. inflation data. The expectations here that we're going to get an uptick on the headline number to 2.7%. That would be a significant leg higher, of course, for U.S. inflation. That would be the highest reading, in fact, since July's 2.9%, and the second consecutive month of increase on the headline number. The core reading expected to remain unchanged, 3.3% year on year. And this is the bit that the Fed is, of course, watching most closely. We are looking here mainly at inflation that lives within the service sector. We can clearly see here, looking at the latest contribution numbers, housing is sort of subsumed within that part of housing services in the core services bit. That's, of course, still a bit sticky, but food is steady, and goods as well as energy are at this point deflationary forces. They have a negative contribution to headline inflation still. And the real sort of area where there is stuff to do for the central bank is in that core services section. So it is that core CPI number, the one excluding energy, the one excluding food, that's the most critical. And if we were to come in at 3.3%, that would essentially mark the fifth consecutive month without disinflation. We started with a downtick from 3.3 to 3.2 from June into July, but since July, core inflation has not gone down. And that's really something of a problem for the Federal Reserve, one would think, if not for the recent comments that we've received from Fed Chair Powell last week. Again, Fed Chair Powell in a prior speech, and of course the November policy announcement where he discussed the moving parts after the November FOMC meeting. And all of that seems to point, along with minutes from that November meeting that were recently released, in the direction that policymakers are not prepared to jump on this piece of data or that. They continue to see, despite these recent months of standstill, the trajectory for inflation as heading in the direction of the 2% medium-term objective. They have repeatedly, whether it's Powell or other policymakers or the FOMC minutes, argued for a look through near-term data volatility, especially of the likes that last week's jobs report gave us. And so it doesn't seem like we are looking at the kind of inflation data that's going to change, at the very least, December's Fed policy trajectory. And moreover, if we look at the way that U.S. economic data has performed relative to forecast, we've been talking about this bit for about a week and a half now, this idea that the City Economic Surprise Index has moved through its 20-day moving average after a long string of outperformance from late August, and that this is eye-catching. Not because we're trying to do technical analysis on a macro indicator, that would be ludicrous, but because we're looking at an index that measures data outcomes, not in absolute terms, but with reference to forecasts that come out of economic models that typically look at data on monthly release cycles. Some of it is quarterly, like GDP results. Some of it is weekly, like jobless claims numbers. But the overwhelming majority of key U.S. economic data is on a monthly cycle. A 20-day moving average is about a month, or about a month of trading days. So 5 days a week, 4 weeks, give or take. So one would think that after about a month of data going the wrong direction relative to forecasts, the economists running these models that generate the forecast against which we're measuring here would start to turn the knobs and adjust their models, because they would say, well, reality is not endorsing our model. That means our model is wrong. We need to fine-tune it. And so when you go through the monthly average for this index, the sense you get is that perhaps the fine-tuning has commenced. That there's been enough of a judgment reached that the model is wrong, or models in aggregate, and that now they need to be trued up to what the economy is actually putting up. Which in this case suggests that just like here, or here, or here, or here, you might get, after the move through the 20-day moving average here, continued correction toward basically the zero line, where data is going to be relatively in line with expectations, or at least closer in line with expectations as we go. And that probably speaks to CPI numbers that should be less than controversial. The first upshot there is that the December rate cut is probably firmly on the books. 86 almost percent a chance of the cut being baked into Fed funds futures, and it seems unlikely that you get too far off this square. Maybe you get a little bit lower in the direction of the high 60s, the 70s, if the number is a little bit warmer than expected. But it doesn't look like the Fed is going to get shaken out of this move. Moreover, if the numbers are close enough to forecasts that the view for next year is sustained. As we can see here, for 2025, we're looking at about 67 basis points in easing. It's been oscillating around 60-odd basis points for a while here, as we can see. And that is basically comporting with 2 cuts being baked in and some speculation about the probability of a third, but not particular conviction. We'd have to get in the direction of 70 and change, and obviously 75 would be a full 3 cuts. So we're sort of on the fence about that third cut here, but 2 of them are in the outlook, and we can see that that has marked a very significant dilution from what was there when the markets started to think about the beginning of the Fed rate cut cycle in earnest before the initial move in September. We can see here the total was 233 basis points for this year and next, of which 100 basis points, right here, was this year. Now, of course, we know at this point that 75 basis points of that has already been delivered. 50 basis points in September, 25 in November, likely another 25 in December. So it's next year's outlook that's the moving target. If it was 100 about basis points for this year in September when the markets reached their sort of dovish crescendo speculatively, then it was about 130, 133 basis points for next year, and now at 60 and change, it's been cut in half. That's in part, of course, because U.S. economic data has been doing better relative to expectations, suggesting the economy is anything but cool. And the response has been, since September, a rise in inflation expectations. These are 5 and 10-year break-even rates from the bond market that give you the priced-in expected inflation that the bond market is telling us is there. That rise in inflation expectations gave us higher yields. Here we have both the 2 and the 10-year going up, so the curve is shifting up at the front and the long end. And of course, the dollar has rallied. But what we've seen since mid-November is some of these moves have started to correct because the markets have basically settled on expectations. If we take a look at what's happened here, again, since mid-November, there's been a peak in the sort of move to reprice this and a bit of a correction. Against the backdrop of that, this redistribution of speculative positioning, not that the narrative has changed, but just whatever speculative capital was looking for just this as a trade seems to have had enough of what it needed to see to start taking money off the table by the second half of November and obviously going into December. If the CPI numbers are relatively in line with forecasts, then this might continue. This might get the green light for its next leg, which might mean lower yields, might mean a weaker dollar in the wake of these numbers, as long as they're not shocking. Then the interest rate story continues, but from the other major non-China driver of global growth, and as we've said here quite a lot, the Eurozone, the US, and China together comprise 58% of global GDP, conservatively speaking, because a lot of the other economies in the remaining 42% are vendors to these big three and need these big three to have growth in order for them to have export demand and growth in turn. Before we get to China, though, it's the Eurozone. Here we have a monetary policy announcement from the European Central Bank this week. Expectations are firm that there's going to be another rate cut of 25 basis points. We can see it is almost all the way baked in, about a 70-odd% chance that this move is going to occur. And as a matter of fact, if we look beyond this year into next year, the curve, the futures curve here, would imply that actually the perspective on the ECB going forward has become more dovish relative to when the central bank met in mid-October and in mid-September. So mid-September we can see is the more hawkish of the three curves here, and then over time we have a rate cut from 3.5 to 3.25 in October. That's that shift right here. But we can see the tail end of this curve is a little bit steeper than the tail end of the current curve from January onwards. So the markets are expecting a little bit more dovishness from the ECB. And in fact, we can see that correction here. This is that October up through now expansion of dovish speculation. And as we can see, it's not coming from expectations for this year. That's pretty well locked in. It's coming from a more dovish outlook on next year, where we're now expecting about 110 basis points in rate cuts. So leaning on 4 cuts with some optionality for a 5th. Not much, but a little less than half of it is there. It would need to be 125 to be the full 5. So we can see why this is, of course. Eurozone economy, looking at the latest PMI data, is coming apart. It had a little bit of a rebound into positive growth territory as ever. PMI numbers have positive growth above 50, which is the neutral kind of boom bust level here. Below 50 is contraction, above 50 is growth. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. We can see that, of course, manufacturing has been in contraction going back to 2022, but the overall economy here has been following the service sector. That's the orange line. The catch-all is the composite in the kind of grayish, bluish line there. And what we find is that at the end of last year, there was recession-like conditions in the Eurozone, well under 50. We had a little bit of a pop in the first half of this year, little bit of a attempt at recovery. And of course, since then, things have unraveled again. We are now back below 50 across the board. And the most recent composite numbers are, of course, eye-wateringly weak as services contracts again. So it makes sense, really, why along the same period of time here, the outlook has become more dovish. Does look like the economy needs more stimulus. However, looking at the latest numbers from the Republic of Germany's finance agency here on break-even rates, again, this is a measure of inflation expectations baked into the bond market, we can see since bottoming in October, there's been a little bit of a wiggle higher in short-term inflation expectations in Germany. This is kind of a benchmark, a sort of bellwether for inflation expectations regionally, and that you've had this rebound may give the ECB some cause for pause. They may not want to jump out the window and be even more dovish than is already expected because inflation expectations are ticking the wrong way. Now, maybe this is just a correction. Maybe this is a temporary development ahead of the winter as preparations get made for another winter with energy supplies at the very least disrupted by the Russia-Ukraine conflict that continues. And there is perhaps some risk premium built into these inflation expectations around what could happen if it were a cold winter this time, which it hasn't been over the past 2 years. And of course, the energy supplies in Europe at this point look well stocked, but markets do speculate. So it's unclear why this is popping necessarily, but popping it is. And if we consider then the ECB's position with the shrinking economy but rising inflation expectations, they already have a bunch of dovish intent on the books. They may not want to dial it up quite right here. And with that in mind, you might see a relatively status quo ECB that doesn't move the needle too much this way or that. You get the cut, you get the dovish rhetoric that cements you for easing next year, but maybe you don't get anything that's even more dovish beyond that in this kind of inflation expectations upswell that we're seeing here, modest though it is. And that may give a push higher to the euro, if only as relief that the ECB, faced with the economy hitting the skids again, isn't prepared to flood the zone with more money than it's already committed, at least looking at expectations. And finally, there is China, the world's second largest economy and the third in the world's top 3 economies. Here, we're expected to get a trade report where there is expected to be continued strength on the export side, not quite as strong as the surge of over 12% in October, but November's number is still relatively buoyant here at 8.5% year on year. Imports anemic, just 0.3% expected after a contraction in the prior month. Some of the strength in exports, of course, has been chalked up to front running ahead of any would-be tariff increase from the U.S. with the outcome of the U.S. presidential election and the return of Donald Trump. So it doesn't look like this is necessarily a sign of strength, more like a sign that there is an attempt at de-risking, essentially, before this is going to become a larger issue, because, of course, it is U.S. importers that pay tariffs, and the latest from Chinese PMI numbers have suggested that there's been an increase in export orders and export demand from the U.S., and indeed those very same numbers and those very same surveys suggest what's happening here is that demand is trying to stock up inventories before costs go up, because tariffs are, of course, a kind of consumption tax on imports. So this is probably going to continue to be an uplift on exports for a little bit longer, but it doesn't so much speak to the strength of the overall economy, which remains in shambles. China has had economy-wide deflation for 6 consecutive quarters now, and the inflation numbers that we got published over the weekend here didn't tell any better of a story. Consumer price index numbers still show essentially the absence of domestic demand, 0.2% versus 0.5% expected. The situation on the wholesale side is a little bit better, slightly slower decline than anticipated, but nevertheless, they've been in negative territory going all the way back to mid-2022. What's more interesting in China is that there was a meeting of the Steering Politburo Committee, that's the 24 top Chinese officials, including President Xi Jinping, over the weekend, and they once again started to put some feelers out there and to stoke some hopes out there that maybe they're finally ready to provide some fiscal stimulus that works. Monetary stimulus has abjectly failed for about 2.5 years now, because we clearly see that flooding the market with money has not created demand. As a matter of fact, new loans as a share of GDP have been falling at an increasing rate, not the other way around. We should be seeing loan growth buoyed by aggressive monetary easing, such as it has already occurred and such as is being promised now for next year, but it plainly hasn't worked. And the People's Bank of China, the central bank, has done surveys showing that if presented with new capital, overwhelmingly most consumers would prefer to save that money because they don't have confidence in the direction of the economy. Very few would either invest or spend. Close to 70% would save. Moreover, bank deposits are at record highs, highlighting that that's exactly what's occurring. So what's needed and what everybody's been pining for is the government basically creating the kind of demand replacement that we saw during COVID in the US and the West, where the government spends a bunch of money to get the economy kick-started. China has been resistant. The Politburo over the past day or two here said they're prepared to be more aggressive and more accommodative on the fiscal side. We can see the response here. The Aussie dollar, a proxy for Chinese economic momentum, it popped here, though it didn't overtake its down move on the whole. If we get a set of trade numbers later this week, which, like recent Chinese economic data, which has carefully edged up relative to forecasts above zero, such that it's cautiously tending toward outperformance, CPI numbers notwithstanding, if that gives us reasonably okay trade numbers, then perhaps Beijing's officialdom is going to get the benefit of the doubt on these fiscal stimulus pronouncements, at least until a few weeks or months pass and it is clear, if it is clear, that they don't mean it yet again, because we saw this movie in September and nothing came of it. Perhaps something will now, but as long as the data is not awful, maybe the markets are prepared to believe that this time is different. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what might follow. I'm on for Futures Power Hour with Chris for Mondays and Fridays, on with Victor Jones for the Price of Truth on Wednesdays, back with Victor and Tom for First Call on Sundays at the Global Market Open, writing for the News and Insights portion of tastylive.com, and commenting sporadically on the platform formerly known as Twitter, as well as on Blue Sky at Ilya Spivak. Thanks very much for joining. Macro Money's back tomorrow.
Oh, yeah. It is Monday, December 9th, a little bit after 5 p.m. Central Time, the best time. You know what that means. It's time for Tasty Live's evening show, a little show called The Price of Truth, the podcast where we like to explore the incentives that govern our world. It is Monday, everybody. You know what that means. It's a solo show. So what I'd like for you to do, shout out to everybody watching on tastylive.com, shout out to everybody watching on Tasty Trade desktop and mobile applications, but if you want to be part of the conversation, there is only one place to do it, and that's head on over to Tasty Live's YouTube channel. Type in Tasty Live, subscribe to the channel, jump in to our little stream here, and start typing. Get your phalanges working. Tell me whether you made money, whether you lost money. Quite frankly, it doesn't matter what you say. Type in random ass characters so we can spoof the Google algorithm into putting this in front of as many people as possible. Speaking of the people, because this is a show by, of, and for the people, we should say what's up to the people. Shout out to Lone. Shout out to Grumpy Mike. Shout out to Dav, Crypto, and so many more. Cato, I see you. Happy Monday to you too as well, my friends. What a day. What a day. What a day. They look like they're running out of steam. Is one down day, a little red on your screen, and I'm not quite sure what to do with it. I'm not quite sure whether to be happy or whether they're just, what's that scene? They pull me back in right when I think, gosh, you can't really use a movie quote if you don't know the whole thing, but I did it anyway. Just when I think I'm done, they pull me back in. There it is. The NASDAQ, my babies, down 0.4%. The Dow Jones down 0.5%. The Russell down 0.2%. And the S&P down 0.2% as well. That's right. And we could throw this up on the screen if you'd like to. But the point is, Cato asking, time to sell the NQ. I don't know. I told you guys I was trying to stand in front of the train last week. So today was a little bit of catch up. It was a good day. It was a needed day. I don't know if it's time to sell it. Only if you're a crazy person. I don't think many people are standing in front of this thing, which is why. Who knows? Maybe it's time to roll them over. Cactus Leo, Dumb and Dumber quote. No. That's not a Dumb and Dumber quote. Volatility. Make volatility great again, I suppose, was today. That's not a political quote. There's a hat floating around. Our good friend Jem Carson wears it every once and again. But the point is, we were on Sunday talking about a VIX with a 12 handle on it. 14.19 is where we are at today, up $1.40 in percentage terms. That's a gigantic move. That's sort of the whole point and premise of what we were talking about on Sunday, which is when we get to these low periods of the VIX, statistically, you have a higher probability of trend, higher probability of autocorrelation, higher probability of lower vol in a low vol regime, which means higher probability of a statistical climb to the upside in S&P price. But because you've got this little right-leaning distribution to offset your expected value, you also have a higher or a fatter left tail. That fatter left tail makes up for your expected value of the likely right-leaning distribution, or a likely market that's going to trend higher with lower vol. And in order to make up for that right-leaning distribution, you get a fat left tail. The potential for jump risk is what that means. So the potential for a quick correction to the downside. And it depends on who you are, what your style is, how you play these little right-leaning distributions. But my personal opinion, I was coming into the week trying to play for that down move, and but I can tell you, 4/5 of 1% was not the down move that I'm playing. You know what I mean? I'm playing the 2 to 5% move. But beggars can't be choosers. I'm not gonna be upset about this move. It's a good start in the right direction. Cato Prime time sell. And Q read that one already. Loan. We're talking futures, my babies. That's right. Grumpy Mike lost a crap load of money today. Just a normal day. Grumpy Mike, I know you're being facetious there, but we can't be losing the whole stack on a 4/5 of 1% day, my friend. If 80 basis points is going to do us in, we got to size ourselves up a little bit differently. Do we have to get back into China again today? Nice little rip in China today. We had said this before, my babies. We had said what their whole move to talk about the economy mid-year in September. That was an anomaly. They normally, the Politburo doesn't come together to put out their economic plans until December or November, December, and they likely weren't going to do it until December because of the U.S. election and the likelihood that they want to see the direction that the U.S. is going before they make sort of concrete future economic plans. So, we had sort of said coming into the early parts of December, expect some economic announcements out of China. The likelihood that you're going to hear austerity is probably not the direction that they're going to go. So a lot of positive headlines over the weekend about them. I don't know if this was their do whatever it takes type moment. Mario Draghi, but some very supportive language coming out of China and their Politburo around their support for the economy going into 2025. And you saw, I've got FXI up on your screen, which had basically based out around $30, up 10% here today. And but that goes for some of the holdings as well. So I can bring you through some of these. Alibaba, these are some of the holdings I have here. Baidu, which quite frankly, Baidu to me has been the underperformer, right? Alibaba, JD.com, all of those things, PDD, which is Pinduoduo, which I believe is Temu, somewhere in there. Those instruments are all, it's like straight consumption, right? So if you're sending out money to people for consumption, the idea is somehow that will more positively impact those types of names. And I get it on a first order basis. That's probably true. So a lot of those more consumption based names have held up better than like a Baidu. But to me, like if they want to get going on like their chat GPT types business, their AI type consumer business, Baidu's a likely benefit from this. So some part of me scratched my head wondering why this one trades so cheap, but the market always knows, right? We're never smarter than the market, but in my personal opinion, for whatever that's worth, this one's still trading a bit cheap relative to its U.S. counterparts. Is it time to buy it? It's always funny because we want to ask that question after the move, right? I think I said last week sometime, it might have been the Friday or the week before, I just started to nibble again on these things just a little bit, but I have nowhere near the position that I had when we got that gigantic move. This one, I probably sold out of 60% of the position at this point. But I don't know. I would be careful of buying on the 10% move. You know, thinking, is it time to buy? After it runs the 40, 50% move, then you go, okay, should I buy this? Or it runs 10, 15%, is it time to buy? I don't think that's the way we want to look at this stuff. Let's see, VIX didn't move much. I would agree on an absolute basis, on a percentage basis, when you get down to 12 and you move $1.40, you know, it's a 10% day. K-Web holds all the Chinese tech. That's right, Caspian. I don't know why. I always invest in the individual names in Chinese tech. I never use K-Web. It would make my life perhaps so much easier. But thanks for bringing that one up. I won't because of the possibility of sanctions. Prince Caspian is pointing out. Yeah, I think that's the whole point, though. So the reason you're going to get these things trading with a deep, deep discount relative to their U.S. counterparts is multi-part. One part is because of the lack of predictability of the home government. Over the last couple of years, there's been tons of sort of government intervention that has been, the government has made a lot of moves in the interest of the government at the expense of the shareholder, at the expense of profit motive. And when you do that, it creates a lack of confidence in the investing public. So I think that's one of the reasons. Second reason is the potential for delisting. For the last several years, we've been flirting with this sort of back and forth with Chinese listed or U.S. listed Chinese equities. So the real potential that a sort of Cold War type conflict could escalate into some sort of hot war, and in that scenario, what that could mean for delisting, or even prior to escalation into a real hot war scenario, just cutting off capital investment could be an escalating step. So that's there. You know, I can name 4 or 5 other risks here. But the point is, all of those risks are known and they are reflected in the deep discount that these Chinese equities will trade at. They're not as cheap as they were trading sort of mid-year. Most of these things were trading with single-digit forward PEs. So they played a little catch-up to get closer to fair value, but they're still trading cheaply. Let's see here. Let's keep cruising. I thought, you know, the relative relationship here, the way the market traded today, the relative relationships, and by that I mean the Russell versus the NASDAQ. Russell outperformed by 20 basis points today. So in other words, if you were long Russell, you lost money, but if you were short NASDAQ, you would have made more money on the NASDAQ short than you would have lost on the Russell. So on a relative basis, long Russell, short NASDAQ technically worked today by 20 basis points. So it played a little bit of catch up. And I think that's the value of putting on these relative basis trades. I'm not in this one right now. I would rather just be outright short NASDAQ. But I think that's the value, especially if you think you're in one of these inflection points where you could see weakness across all of these indices. If that's the case, you want to bet on the outperformance of one versus the other. I think that makes a lot of sense. But in my particular case, I'm being a little bit greedy. I'm going for the NASDAQ sell-off, which famous last words. Famous last words. All China news acts like a massive short covering rally nowadays. Exactly. These things tend to carry high percentages short. So you do see these massive sort of short coverings. It's part catch up and it's part short covering. I would agree with that. All right, let's keep going. Looking at bonds here today. The forward size ZB 119 and 13/32, so nearly half a point. We were down about a point today. A little disappointing in that give back. We had played the long end of this range and played the breakout of the sort of the 116 or the 115.5 to 118.5 range, and we played the break out of that. Luckily, we were rewarded. Sometimes better to be lucky than good. Taking a quick look at the yield curve. Again, we always put up 3 different lines for comparison here. The red line is effectively what the yield curve looked like before we embarked, or as we embarked on this rate cutting cycle. So that 50 basis points in September. This is what the yield curve looked like September 18th. The green line is what the yield curve looked like November 7th, was right before the second cut, which was the 25 basis point cut in November. And the blue line here is where we are now. So you can see, obviously, we've eased off those highs. If I were to go, I think some point after the election, and the 30-year, we're lower by, what's that, about 15 basis points or so. So it does seem like it took some time, but we are starting to ease in the long end versus what we saw in September. As soon as they start lowering those short end rates, and you can see that here, right? You can see those short end rates here. As soon as they start lowering those short end rates, the opposite was happening in the long end. The long end starts lifting as the long end has a little bit less confidence about the inflation picture over the long end, and perhaps a little bit more confidence in the growth picture in the long end. All that has to be factored in, and you don't have a Federal Reserve who's sitting there as a non-economic buyer just buying in all these longer dated tenors, and they're able to respond to just growth and inflation. And in that case, you got a little bit of a long end lift. And the question was always, is this the bond market revolting against the yield, the policy stance of the Federal Reserve? Or is this kind of what always happens? It's not uncommon on the cut to see a little bit of a lift in the long end before normalization over a longer term period. And the question again in this show, and on any people who have been watching the yield curve, is whether or not, again, that was just sort of that normal short-term phenomena, or is this sort of a revolt against the monetary policy? Still hard to see. And in the coming next week, on the 16th, we're going to get another summary of economic projections. We're going to get what is likely another cut. Oh, come on. Let's look at the probabilities. They basically shored up the probabilities of a cut on the 16th, 85% now. So we flirted a week ago with the idea that they might not go, right? There was about a 60% chance that they cut, about a 40% chance that they don't. The market was easing into the potential of pricing the cut out. But now it looks like we fully priced it in at 85%, and I doubt that that's going to go anywhere anytime soon. Depending on there are the inflation numbers that we're going to get later this week, just to show what this is going to look like. We're going to get the 10-year. We're going to get the CPI on Wednesday morning. The 10-year auction later in the day, and then we're going to get PPI on Thursday, and then the 30-year auction later in the day. So anything is possible. You could see, a warmer than expected CPI. The expectation is to come in month over month at 0.3%, which is a bit warm. It's warmer than last month, 0.2%. So there's already an expectation of a warm number, 2.7% year over year versus the 2.6% last month, year over year. So there's an expectation of a warm number already. If you get something warmer than expectation, it is very possible that that we see something different here. But if I was a betting man, and I am, if I was a betting man, and I am, I would probably say that they move forward with the cut, and if anything, they probably give a hawkish summary of economic projections. I'd say they likely want to get this this extra 25 basis points cut in, and they probably, if they want to go hawkish, they lean hawkish with their summary of economic projections, which we took a look at last week. But just as a reminder, This is where they left us on how to think about the future. You know, these are usually as valuable as the piece of papers they're written on. But the future from the Federal Reserve standpoint as of last September was 2% real GDP expectations, unemployment rate at 4.4%, PCE inflation at ending the year at 2.3% and going down to 2.1%. I think the likelihood is that they raise these inflation expectations for 2025 and perhaps even just a bit in 2026. Core PCE inflation, 2.6%. I think the likelihood is, because 2024, all this is going to drop off. The likelihood that they likely raise core PCE inflation expectations in 2025, I think, is high. And then what is almost a certainty, I probably bet my life on this one, is that this is not going to stay at 3.4%. And sometimes it's as easy as just looking at where the 2-year is. When they put this projection out, the 2-year was at 3.5%. And so it was not a stretch of the imagination that they put 2025 Fed funds rate at 3.4%. But now the 2-year is at 4 and change, 4.07, right around there. So the likelihood is that they move this up somewhere towards 4%. And if they do that, what they're effectively saying, what the market, the implied pricing that the market already has priced in, the market is priced about, I can show you here, the market is priced about 2 to 3 cuts next year. So if we look at the CME Fed Watch, you just go to the aggregated probabilities. There's different ways to look at this. You can look directly at the yield curve to pull this out, but if the CME is already going to do this for you, it's an easy way for you to look at it. So the probability here, we're in a target range, 450 to 475. The likelihood that at the December meeting that changes, they've got an 85% probability that we're going to drop a quarter of a percent, 25 basis points. Then the likelihood for the next meeting at the end of January is about 88% that we hold at that same policy rate. The next meeting in March, about an 80% probability that we drop another quarter. Then the next meeting after that, 85% probability that we hold. In June, about a two-thirds chance that we drop in June. So you can basically look at these aggregated meeting probabilities, and you can see not only the probabilities, but the speed with which the market is pricing in. So it's basically, after you get December out of the way, you're looking at 25 basis points every quarter, once a quarter, until you get into the end of the year. By the end of the year, it's saying 1, 2, and then 3. So somewhere between 2 and 3 is where the market has priced, but the timing of that third one is fairly uncertain once you get past June. That's effectively how the market is pricing this so far. Just an easy, quick way to look at that. So the likelihood that when we get this summary of economic projections back from the Federal Reserve on the 16th, this number is likely not going to be 3.4%. It's probably going to be in the ballpark of 4, 3.9 if they want to be generous. If I was a betting man, that's what I'd be betting on. I would guess maybe a little bit more hawkish, so they leave it at 4. That gives them room to be a little bit more dovish. But we'll see. That's my guess. What's yours? Catan, what's going on? Vince K says, just insights from appliances manufacturing. Volumes are low. Next year outlook is calling for low volumes. Therefore, housing building forecasts are low. No new orders. I think Fed needs to cut. I think they will. Disappointed. Trying to follow the chat here. So yeah, that's
Raindrops and roses and whiskers on kittens, bright copper kettles and warm woolen mittens, brown paper packages tied up with strings. These are a few of my favorite things. Cream-colored ponies and crisp apple strudel, doorbells and sled bells and schnitzel with noodles, wild geese that fly with the moon on their wings. These are a few of my favorite things. Girls in white dresses and blue satin sashes, snowflakes that stay